I would like to thank our partner, the United Nations Sustainable Stock Exchange Initiative, for co-organizing today's going beyond the balance sheet, Disclosure and Transparency Toolkit, and extend a very warm welcome to all of you for participating. I would like to take this opportunity to explain IFC's environmental, social, and governance work in the region and how companies have reaped benefits from adopting the best ESG practices. We believe this is especially pertinent now as businesses that demonstrate good leadership, communicate clearly, and manage crisis well can better handle these unprecedented challenges, basically COVID-19 situation. Numerous studies have shown a direct link between companies' ESG practices and financial performance. IFC reviewed the performance of more than 700 companies in its portfolio very recently and found that companies with good ESG practices, ESG performance, tend to outperform companies that don't have that good ESG practices. So there's a clear linkage between companies' ESG practices and companies' financial performance. ESG analysis has been a formal part of IFC's appraisal process and is required for every investment transaction as part of our due diligence process. And around 90% of our investment clients across emerging markets believe that IFC's ESG requirements are helpful for their long-term business success. So in East Asia Pacific, we have been working with regulators and market players to strengthen corporate governance practices and the investment climate while helping private companies across different sectors to improve their performance and attract investment. So in countries from Cambodia, China, Fiji, Indonesia, to Laos, Mongolia, Myanmar, the Philippines, and Vietnam, we promote good corporate governance, good ESG practices. We build the capacity of local partners, institute of directors, the media, and education institutions on ESG services, trainings, as well as reporting. So through our work with our market regulators, we have facilitated the adoption of more than 30 corporate governance related laws and regulations in East Asia and Pacific, including 13 from Indonesia, 6 from Vietnam, 5 Mongolia, number of regulations from Philippines, China, as well as Myanmar. And we currently have Laos Securities Exchange Commission office with developing and issuing country's very first corporate governance code. And currently we are working with the Securities Exchange Commission of Cambodia, again on the country's very first corporate governance code. Regarding today's TOT, Train the Trainers program, there are 3 countries joining us today, including representatives from stock exchanges, universities, companies across a wide range of industries from Indonesia, Fiji, and Myanmar. And in terms of our market level partners, I can see that from Indonesia, we have IDX, Indonesia Stock Exchange, online today. IICD, Indonesia Institute of Corporate Directors, CRMS, Center for Risk Management and Sustainability, LKDI, Indonesian Institute for Commissioners and Directors, FPN for Family Business, and Indonesian Institute for Corporate Governance, KNKG, on top of other institutes and private sector companies. From Fiji, I can see Reserve Bank of Fiji, and also there are a number of participants from Fiji National University, and again, number of private sector companies. And finally, from Myanmar, we have participants from Securities Exchange Commission of Myanmar, Yangon Stock Exchange, UMFCCI, the Chamber of Commerce, DICA is also online with us today, Myanmar Microfinance Association, as well as MCRB, Myanmar Center for Reporting Responsible Business, and also MIOD, again, a partner institution for IFC, Myanmar Institute of Directors, as well as many other institutes and companies are online with us today. So during this TOT, we will be discussing the business case for transparency, as well as how companies can attract capital and build sustainable enterprises. And at the end of this event, we would like to hear from you about your plans in terms of improving D&T practices in your organizations and in your respective countries. And of course, any support that you may need from IFC. We will have a brief discussion on that, but after the TOT, we will be sharing an action plan with each organization, and we will have follow-up discussions. So without further ado, let me introduce Ms. Raliza Garbanova, who will be moderating the panel discussion on how companies attract capital and build resilient enterprises. Raliza is part of the IFC Corporate Governance Group. She works with regulators, partner institutions, private sector companies to improve corporate governance practices in Europe, Central Asia, Africa, the Middle East, and Asia Pacific. So basically all around the world, she's working with all these partners. Raliza is leading the practice group on codes, standards, and ESG disclosure and transparency, and works on development of knowledge, tools, and solutions in these areas. She's one of the principal authors of the Corporate Governance Scorecards and Disclosure and Transparency Toolkit, and she supported development of more than 20 corporate governance codes and scorecards. So over to you, Raleigh. Thank you.
Thank you, Liao, and good morning, everyone. And thank you for joining us virtually at today's training of trainers. I'm normally based in Washington, D.C., but joining you today from my home country, Bulgaria. So why is transparency and disclosure of environmental, social, and governance issues important in times of crisis when everyone is focused on financial survival? For decades, reliable, comparable, consistent financial information has given investors the confidence to buy stocks and bonds, creating incredible wealth and jobs. Can I just kindly ask people to mute their phones while speaking because of the noise? Thank you so much. So investors need similar information about the sustainability of companies and investments, so they can direct the trillions of dollars coming to fight the current crisis the right way. To put it simply, transparency builds investors' confidence and shows the most resilient companies. But transparency is not about sounding good, it is about doing good. Your company's annual report and disclosures are a reflection of the quality of the underlying culture, strategy, governance, and performance inside the company. Excuse me, can I kindly ask again for everyone to mute the phones because we're hearing the sound the noises there. And today we are not going to talk about philanthropy or corporate social responsibility, which describes the company's social responsible commitment, efforts, and practices. So we'll focus on the environmental, social, and governance, or ESG issues, a set of standards for investors and other stakeholders to evaluate a company's environmental, social, and governance performance. The concept is based on the fact that companies that best manage their environmental and social impact and have better governance practices are more profitable in the medium to long term and experience less losses during crisis. This could be achieved by strengthening health and safety measures in hospitality assets to ensure guest well-being, by saving energy costs or reducing carbon emission. Therefore, it's more important now than ever for businesses to actively communicate changes to strategies and practices with investors and other stakeholders, such as regulators, customers, employees, and the communities in which they operate amid high uncertainty. This session today will provide an overview of the strategic value and challenges of ESG disclosure and practical tools such as the IFC's Disclosure and Transparency Toolkit on how to respond to them. You will learn as well about the UN Sustainable Stock Exchanges Initiative role and model guidance on ESG disclosure. This was just a short introduction from me, and we are having an exciting panel for you from all around the world who will present what and how to disclose material ESG issues about companies' strategy, governance, and performance, and tips for crisis response. Each trainer will have 20 minutes to present and 10 minutes to answer questions. Please use the chat box or unmute to pose your questions. In the discussion activities.
Hello.
Can I kindly ask everyone to currently mute? I'm sorry, we are hearing some of the participants. Can we please kindly ask you to mute? Thank you very much. So all the materials will be shared with you. So we are starting today with the first presenter, and you will see his presentation, Mr. Jerome Levine. Jerome is an expert in global corporate sustainability and responsible investment with 20 years of experience in sustainability, finance, and law. Jerome currently serves as a senior consultant for the IFC and a senior advisor for the UN Global Compact. And
hi, Riley. Sorry, can I interrupt just to draw attention? Saya utat phone le mali chamaro adani jani are mute lo pe lo ya mala mati bu shin saya ye. Please continue.
Thank you very much. Thank you. So we are starting with our first presenter, Mr. Jerome Lavin Delville, and he is one of our senior consultants for the IFC and a senior advisor for the UN Global Compact, focusing on financial innovation for the Sustainable Development Goals. He is a key architect of the Sustainable Accounting Standards Board standards for material sustainability disclosure and the UN Global Compact Transparency and Disclosure Framework. He also has played a key role in a number of critical investor companies initiatives to integrate sustainability in finance, including valuation of sustainability performance, ESG investors briefing, and the Sustainable Stock Exchanges Initiative. This was just a short briefing from me. There was not a presentation for it, but I can send the talking points as part of the presentation package. Jerome, over to you.
Thank you, Rarisa. Can you hear me? Hi, Raditha.
Yes,
Can you
we can
hear
hear
me?
you.
Hello. Can everyone hear me?
Yes, Jerome, we can
Yes,
hear
we can
you
hear
well.
you.
I'm sorry. And then
Jerome, we can hear you, but we do not see your slides as yet. Is that okay?
so I'm not sure how to share my slides. Can you see it now?
No, not yet.
Okay. So in that case, I'm wondering if someone would be able to present. Maybe Ni, if you could maybe put up the slides, because I'm not sure how to share the slide on this platform.
Jerome, I don't receive your slides yet.
You have.
If you scroll your mouse on the screen, you will see the arrow share screen. You click on there.
What part of the screen? I'm sorry.
Next to the
The
video
mouse on the
icon,
screen, and
there is a share
arrow
content
symbol.
icon.
Hello.
And we hear you, Jerome, not your slides yet.
Okay. Let me see. So I apologize deeply for this. Raditha, would you be able to maybe put up my presentation?
Yes, Jerome, just grant me access to the Google Drive. I send a request.
Okay.
Trời ơi, chưa thấy cái ông nào mà lề mề.
Okay. This was so Nia, I granted you access. Let me see. Did you get access, Raditha?
I am looking.
Yes, I
Not
get it.
yet. Not yet, Jerome.
Okay. Okay, I'm going to send you a PDF in that case, because I'm not sure what's happening. It should arrive very soon.
I got your presentation. Let me share. Thanks.
Perfect. Thank you, Ni.
Okay, let me know when the presentation is up. And again, apologies, everyone. Okay, thank you very much. So without further ado, so if you can switch to the second slide, the introduction. So we wanted to give because this is the first presentation of the series, we wanted to give in the context of why is it important to disclose on ESG transparency when everyone's focused on financial sustainability, especially in this time of crisis. And one of the reasons is that no matter whether you're looking only at financial performance or the overall a more broad enterprise value creation or the economy and the environment and the people, ESG transparency and disclosure is relevant at all levels. And so therefore, one of the key tenets of the toolkit for transparency and disclosure is to integrate environmental, social, and governance issues at the core, in the core functions of the company at the strategic level, in the corporate governance aspects of the management of the company, and also in assessing and reporting the performance of the company. And again, as we see the world today and the increasing role of companies in social and economic development, it's really critical that companies, even if they are looking strictly at financial sustainability, that they look at environmental, social, and governance issues. So if we switch to the next slide, the toolkit for transparency and disclosure, which is also called Beyond the Balance Sheet, it's a resource that's available for everyone on the website of IFC. Essentially, is built upon the concept that modern management and governance of companies is done around three pillars. One is the strategy of the company, the governance of the company, and then how it performs. And there's a certain cycle to those three pillars, such that, performance at the end of the cycle informs strategy for the following year. And in the context of an annual report, investors and other users of the information are going to look to see that continuous cycle of improvement, if you want, starting with setting goals, having a business model, making some strategic objectives, analyzing the risk, understanding how sustainability fits in that, then showing the reader how corporate governance mechanism and structures are set up to oversee that strategy and the implementation of the strategy through the board, the control environment that ensures that the monitoring of the risk and the performance of the company is done at the highest level, as well as the governance of minority shareholders and stakeholder engagement. And at the end of the process, the critical aspect, and this is going to be a theme of my short presentation, the critical aspect of reporting on performance, both the financial position and performance, but also the sustainability performance. So just in broad stroke and as a matter of introduction, and to put the context out there, that this is a comprehensive look at how companies function. This is not a siloed look at how companies are good citizens. I mean, that's important, but we're really looking here at integrating ESG in the core functions of the company, again, strategy, governance, and performance. And so if we switch to the next slide, so we are now introducing a training of trainer. Therefore, I'm not seeing the slides anymore, but the idea is that we would introduce at this point of the presentation some questions for the audience if you were training.
Jerome, we're not seeing the slides either.
Ah, okay.
Let me share. I'm sorry, it's getting bad. Is that the slide? Do you see my slide?
Not yet.
No.
No. Okay. No. You should be.
It was coming up. It was just about to come up.
But it kicks me out. What's the problem?
Okay, here we go. Okay, so at this point, we want to introduce the audience to a concept, and thank you, Raditza, for sharing your screen. To the fact that you know, at the end of the day, the IFC and the programs that we are running are essentially about helping companies in emerging markets to attract capital. And we believe firmly that disclosing information on ESG in a manner that is integrated in the company's main management and governance processes is helpful to attract capital from international investors. And that's certainly something you may have heard before. What we find is that you know, there's a lot of talk about the fact that sustainable investment is rising. There's more and more issues of green and social bonds, but we wanted to know from before we start a little bit from the audience what have you seen as an opportunity in the companies around you, in your market? What opportunities have you seen for leveraging ESG information to attract investment, to attract international investors? Have you seen an increased demand for ESG information by your investors? Or have you seen companies in your market being interested in issuing sustainable finance products? And the reason why we want to do this is to get a little bit of a sense in the room of, where do you stand? What's your need? What are some of the questions that you have when addressing this topic of leveraging ESG information to attract capital? So we'll see if the format works on a WebEx call, and sorry for the technical difficulty in starting. But if there's anyone that is on the WebEx that would like to share briefly some signs, some opportunities they've seen with attracting capital using ESG.
Perhaps I could jump in from a Myanmar perspective. I think that the G for Myanmar has always been extremely important when it comes to attracting capital, because there is the perception that Myanmar is a high-risk market. So this is not new, it's not post-COVID. It is just a fundamental need of companies to get their G bit right, and to some extent their S, because that relates to human rights risks, which are also significant within our market, and which are an area where a lot of shareholders, stakeholders, and media will focus on.
Thank you. That resonates very well with many of the frameworks and guidance and tools of the IFC including the performance standards of the IFC that are focused much more on the social aspects, precisely because it is the perception that among the various sustainability risks, E, S, and G, that social and governance are highest in some of the emerging markets, and therefore part of the actual or perceived risk that investors have about the country, and therefore add to the cost of capital in compensating for the increased risk. And often what we see is that it's not so much that it's riskier, is that the lack of disclosure on these topics, the lack of information reaching investors, leads them to automatically assume that it's risky and therefore discount the whole market with that risk, no matter how specific companies could do on that front. So that's very interesting. Thank you so much. Anyone else would like to comment at this point?
Jerome, there's two written comments. One is from Dr. Adrian Teja, who says that yes, however, we do not quite understand how ESG information is important after earnings and growth opportunities or vice versa. And the second one from Krista Avery is saying that the core values that drive ESG are not well understood, not are well articulated in the local context.
Okay. Very well. And to the first question, I think the first question is very relevant to the presentation we'll provide in a second. The other one is definitely a I do believe that there is an issue of when investors talk about ESG having a single common view of what the issues are, or and also this willingness, or this investors like to have comparable information across all industries, all companies, because it's easier for them to then manage their portfolios. Then therefore they tend to have common issues, common ESG issues that they ask every business, irrespective of their industry or their geography. However, we know, and through my work at SASB, we know that sustainability issues are very industry specific, and they're very market specific. And again, on the specificity of ESG issue for emerging markets, I would really point you to the AFC frameworks, which are aligned with international standards, but much more focused on emerging markets. So thank you for participating and playing the game with us. So moving on to the next slide, this is our perception of what the opportunity is. Essentially, wherever you look, this is a slide that comes from Bloomberg, but you can look at this pretty much everywhere on the web. There's a massive growth in the demand for sustainable investment from investors globally, and this is one representation of that, showing that there's an integration of sustainability in pretty much all financial products that investors deal with or manage their portfolios with. Another way in which we could have shown you that is the increased number of investment companies that sign to the Principles for Responsible Investment, the number of investors interested in financial products on sustainable stock exchanges, etc. But no matter how you look at it, there's a very important growth in the demand for investors. Now, one of the key complaint, if you want, of investors that are decidedly looking for that investment opportunities is the lack of investment opportunities. So in that slide, when you see that a vast majority of the investments are made in equity, there's not really a specific product in the equity side that is structured to deliver and demonstrate impact in a very specific way. It's more a matter of investors investing in equity funds that will maybe exclude the poor performing companies, include companies with better performance, but at the end of the day, it's still just the equity of the company, and there's really no way to really parse out, which is good and which is not really good. Now that is changing a little bit because, as you can see, the fixed income part of this is growing as well. And if you go to the next slide, Ralitza, what's happening, and that's changing in the market, and here we have an audience of mostly corporates or representing the corporate side. The big change in the last few years has been the introduction of what I would say corporate finance instrument for sustainability, meaning specific financial products that are created by companies themselves that have a much stronger link to sustainability. And I'm sure many of you have heard of the green bonds and the green bond market, but since the last, in the last few years, there's been an explosion of these products issued by not just corporations, but many corporations around green bonds, sustainability bonds, social bonds, sustainability linked bond. Any name will fit there. We've heard of orange bonds for gender equality, blue bond for ocean-related type of activities, etc. And then on the loan market, same thing. Corporate loans can be linked to sustainability. They can be green. They can be, blue, etc. So with that in mind, and going to the next slide, one could ask, okay, so now we've got demand on the demand side from investors. We got good products that companies could issue to meet the demand, and yet what we see is essentially a contraction of the market to a level where it does not live to its full potential. I think the potential demand for sustainable investment is in the trillions, and I think the total size of the market for sustainable investment right now is probably in the hundreds of billions. So going to the next slide, we're going to look at a little bit the challenges and how we think that ultimately companies are in the driver's seats of enabling this market to grow and to create more investment opportunities for investors and creating a much bigger sustainable finance marketplace. So the first thing I wanted to discuss was most of you will know about the green and social bonds. These are traditionally user proceed bonds. It means when a company issues a green or social bonds, they will dedicate the funds that are raised to very specific activities that are quote unquote green. That's a very interesting product. It was actually pioneered by the World Bank and the IFC and the Development Finance Institution. Works very well in some industries. For example, everything related to energy that is conducted through projects. Or financial institutions operating by investment committee. But there's two issues with the green bond market was that, first of all, green is not sustainability. And we've heard from one of the participants that, in Myanmar, for example, environment is not really the top number one issue. So one thing that's been reassuring and a good trend is that we've seen an expansion of the themes covered by user proceed bonds. So you've got green, blue, ESG, sustainability, social, climate, ocean. There's even one called plastic waste reduction bond that was issued by Henkel, I think. but the point is, so that's good. That's expanding. Again, we're all mindful here of the necessity to expand the market from the supply side, from the companies issuing more and more, investment opportunities to investors. The other thing that we've seen that's interesting is that a number of companies, even though if they call their bonds a green bond, they've included a social dimension. And here I cite the example of Verizon, who recently issued a green bond, obviously focusing on some of the energy efficiency of their, this is a telecommunication company in the US, focusing on energy efficiency of their network, but also including a social dimension in that. And then even within the green dedication or nomination, there's been an increasing variety of purposes that green bonds have been funding. Initially, it was a lot about the energy transition, energy production, etc. But it's becoming more and more inclusive of the green building, sustainable transportation, energy efficiency, going into water, etc. So that's a good trend, and we hope that it continues to grow that way, so that more and more companies of different industries and different geography feel that they can enter the market and have something to quote unquote sell to the market. Another interesting trend, if Ralitza, you can go to the next slide, is and to us this is a critical trend. It's the growth of sustainability-linked finance. So the user proceed model is one where a company is almost doing an off-balance sheet transaction. It's identifying a set of assets, a very specific set of activity, a factory, a power plant, and saying to investors, look, this is going to be renewable energy. I'm not telling you what else I'm doing. I'm just telling you that if you loan me money through this bond, this green bond, the proceeds of the bond will go uniquely to that, and I will show you that dollar for dollar, it all goes there, and I will show you the performance of that asset. The problem with that approach is twofold. One is it does not work for every type of company. Some companies don't operate with big assets or big factory, big plants. The other thing is many companies do not operate by investment projects. Some do, the energy industry, to some extent the banks doing project finance. But for many industries, investments are more operational expenditure or research and development, investing in people, expanding abroad. All of these things are not really fit for purpose for a user proceed bond. The other problem is a lot of large companies were starting to issue green bonds, and people at the UN and other issue advocates were starting to say, well, it's great that these oil companies issuing a green bond for some of the very niche activities they're doing in renewable energy, but what about the rest of the company? And we're now financing a company for just their green aspects, and it's not saying anything about any of the other ESG practices, whether it's social, treatment of employees, treatment of communities, etc. So it's not really a criticism of the model. It's just saying that it left a gap in the marketplace, which has been filled by this notion of sustainability-linked finance, which is essentially a performance-based model, where instead of the mechanism being the proceeds of the loan and bonds being tied to a specific asset, here the catch, if you want, is that the company will set a few targets and goals on key material sustainability topics and tie the interest rate of the bond and the loan or the credit line to the performance on those. And if the company does not perform according to its targets or promises, then it will pay more interest. And the reason why this is good is it allows companies to move outside of the asset-based financing model of the green bond and go into a more corporate-wide model where they can essentially approach investors saying, look, we are trying to become more sustainable. We are integrating sustainability in our strategy. We have investments that we make. We're going to monitor that with corporate governance mechanism that we have in the company. We're going to report on that performance. And on that basis, because we are setting targets, we are able to issue financial products where we put our money where our mouth is, meaning that if we don't perform well or above a certain threshold, we're going to pay for it. And as you hear this, I don't know if you notice, but I'm slowly introducing the concept of strategy, governance, and performance, which is the core 3 pillars of the AFC Transparency and Disclosure Toolkit. In other words, and this is kind of closing the loop a little bit, when we ask why is it important for companies to disclose ESG information, even to financial investors or for financial reasons, it's because the big trend in sustainable finance, and we think that the growth of sustainability-linked finance will open the market, means that investors are going to come to you and they're going to say, if you want to raise sustainable capital, whether through a bond or a loan or a credit facility, you're going to have to tell me about your key material issues. You're going to have to tell me about the targets on those. You're going to have to show me how you monitor progress, and you're going to have to report regularly on performance. And that's the key. Is the financial markets are catching up to the models that IFC has been promoting for the last few years of strong corporate governance and integration of sustainability in all these dimensions. So just a few more slides to show that that this trend is strong. The next slide, Ralitza, if you don't mind. One of the other trends that supports this approach of integrating ESG in all the core strategic governance and performance aspects of the company is the increasing use of sustainable finance frameworks. What you'll see now is that when companies issue even a very specific green or blue or orange bond, the accepted practice has become that alongside the bond itself, where they're going to say, we're going to use the proceeds of these bonds for very specific assets, very specific activities. Nonetheless, alongside those transactions, they will issue a more general sustainable finance framework that outlines the overall entity strategy, targets on key sustainability issues. They usually do that so that they can issue multiple transactions without having to redo all the narrative. So they issue this sustainable finance framework, and then they can issue several bonds, green or other types. But the point is, it's a complement to a strict definition of how they're going to use the proceeds, and it starts to resemble a performance-based approach where they say, we're not necessarily going to tie the interest rate to those targets, but certainly we're going to make you aware that the green bond or the social bonds, even though they are use of proceed, are set within this broad strategy that the company is very serious about and will monitor and will report on. And so Alphabet, the parent company of Google, issued a green bond recently, but they issued with it a 5-year sustainability strategy overview with critical targets that reflects their strategy, their overall strategy on sustainability that investors now need, and that's why these companies are doing that. Same thing with Verizon, came out with a very big issue of a green bond that, as we said earlier, has a social dimension, but they did, even though that was a user proceed model, they did issue very prominently these sustainability targets that they have with very clear ways to measure them, time-bound kind of targets. So it's really interesting how the market's moving that way. Next slide, very quickly. We see that reflected in the normative framework. So the ICMA, the International Capital Market Association, who was the original issuer of the green bond principles. And most of the green bonds issued today are issued according to ICMA principles. They've issued lately, I don't know if you can read, but they've issued principles for sustainability-linked bonds. So they've also recognized that we need both kinds. And actually, those principles, I'll talk to it at the end of my presentation, almost follow the exact same cycle that we are proposing in the toolkit, the IFC toolkit. Similarly, the Loan Market Association, which had green loan principles, has come out with sustainability-linked loan principles. And I think the last one is one of the most important development in that market is the European Central Bank has agreed to use green bonds as collateral for their financing program, and in doing so, they've also accepted sustainability-linked bonds and loans as collateral, and that's a significant decision because, at least in the European Union market, it means that this loan can now be subsidized to a certain extent by the European Central Bank. So, I am finished with the first part of the presentation where we wanted to set the context, talk about the opportunities and the challenges, because if you think about this, these are great frameworks that are coming along that companies can start using, but it's also a challenging road ahead before the market expands to its full potential. Now, for the last part of the presentation, and I just want to check on time, make sure that I'm not going too long. Am I okay, Radhisa?
Yes, you're okay.
Okay, so now we want to delve into how the IFC framework for transparency and disclosure can be used to answer these trends towards investors looking to company and say, look, I want 2 or 3 targets and KPIs that reflect your key material issues. I want you to adopt them centrally in your strategy, monitor them as part of your corporate governance mechanism, and I want to see accounting for performance and reporting in your main medium of communication, in your communication to us. And again, I sound like a broken record, but this is the IFC framework for transparency disclosure is a ready-made framework for that, because essentially what it allows you to do is to set strategic goals and targets on material sustainability issue. It incorporates sustainability issues in corporate governance, oversight, and controls, and it guides companies in accounting and reporting for performance. The next slide has a little more detail, which I think is going to be a little hard to read on the screen, but if you have a chance to go back to the actual toolkit, you'll see we have a diagram like this that explains in intricate details how a company can. So let me backtrack for a second. The IFC assumes that the way a modern corporation is managed and governed, and therefore should report, is along these 3 pillars. And the toolkit gives a comprehensive guidance on how to report on strategy, governance, and performance, not just sustainability, but the whole strategy, the whole governance, the whole performance. And then weaved into that is the idea that at every single step of the process, sustainability can be integrated, and that again, takes the form of at the strategic level, identifying what are the key material, environmental, and social issues. How do you create or embed in your overall strategy your sustainability strategy? So you could have a main strategy and have a sub strategy that is a sustainability strategy, or the whole thing could be a sustainability strategy. No matter what it is, this is the place to do it, and also to create some very clear targets, strategic objectives, and KPIs to measure performance. So this is all explained at length in the strategy section of the toolkit. And again, it's critical for attracting sustainable finance, as we've seen. Now, the governance aspect is critical as well, because setting goals and targets, KPIs, is great. It shows that companies have focused, they've understood themselves in their geographic and industry context with these big trends. But you have to have the highest level of governance, the board and all their committees and the management of the company, really caring about making sure that this gets implemented, this gets controlled, this gets reported, etc. And that's the function of corporate governance. And the good news there is there's nothing to reinvent. The accepted best practice that IFC promotes in corporate governance has all the elements to make sure that sustainability strategies and targets and goals are implemented and monitored and under the oversight of the board and the control environment, etc. Obviously, the issue of stakeholder engagement is critical as well in making sure that they're involved in either the selection of those material issues or how the performance is monitored and the impact. And finally, performance, where we guide companies on how to report the critical material ESG information alongside financial information, and as best as companies can at the same level of quality. And we know that this is we're not there yet. It's going to take a long time before sustainability data is at the same level of quality as financial data. We're starting about 100 years after financial accounting, so that makes sense. But nonetheless, there's more and more progress with companies being able to showcase financial results, operational results, sustainability results in very quantitative and also verified data. So just in closing, thank you for your patience. Just if we go to the next slide, Raditza, and maybe again this idea of putting it into the context of how does ESG reporting and in the way we guide companies to do with the toolkit is really relevant to sustainable finance. And so this is essentially what, if you recall, we said that ICMA had issued principles for sustainability-linked bonds. And this is very recent. And essentially what they say is, look, if you want to issue a sustainability-linked bond, you need to select key performance indicators that reflect relevant material issue for your company. The KPIs are in my mind, a direction of travel. They are, measuring kind of a certain progress along a certain line. And then the target, which is the second part of this, is more the strategic objective on that line of travel. It's like, how far do I want to go on that, And so the second part, and this is the key to sustainability-linked finance, is the setting up of targets, that performance targets that are tied to these key performance indicators on material issues that companies can set. And then in a third step, what they call bond characteristic, is essentially structuring the financial product so that it takes advantage or leverages the fact that the company has these targets that they are willing to vouch for and monitor and perform against, to say either it's going to be part of it's going to affect the interest rate, or it's going to be, this is more a matter of financial experts to structure products that are the most convincing for investors in terms of, does the company mean this enough to put their again, their money where the mouth is. But this is essentially, and in practice, what we've seen is that the companies have given either a step up or a step down in the interest rate on the bond, whether the company will perform a certain way on the key sustainability issues. And then after that, reporting and verification, again, very familiar topic of the IFC transparency and disclosure topic, that yes, it's all about reporting, and what you report should be verified. Very last slide, to show you, this is a little hard to read, but you can look at it at your leisure. These are some of the first companies that issued sustainability-linked bonds, and they're pretty big issuance. I think Enel, which is a Italian electric utility, issued a total of 4 billion of these bonds in several tranches. And you can see that there's also some big issues from Suzano from Brazil, from Novartis in Switzerland, and then Chanel in France. And there's a few interesting things here is that you see companies from industries that were not as typically represented in the green bond market, the pharmaceutical industry, the pulp and paper industry, the textile and apparel and luxury good industry, precisely because what we said at the beginning, these are not necessarily industries that use very heavy assets that can be considered green. And so they found in that model, if you want, a very welcome addition. And it also, and maybe this is my last word, companies, and I'm sure you've heard that in your markets, have been pushed for a long time to integrate sustainability, integrate it in strategy, governance, performance, reporting. Integrated reporting is a huge trend. And in a way, after all this, then they're asked to isolate assets into this green bond user proceed format. And that felt kind of going back a little bit, was this is truly about recognizing the long-standing work that companies have done to try to integrate sustainability as much as possible in their core function, and allowing them to benefit in a way financially from that if they do well. So this is the end of my presentation. Again, sorry for the technical difficulties. I guess I'll blame it on WebEx. I'm used to Zoom, but Raditza, back to you.
Thank you. Thank you, Jerome. That was a very interesting presentation. Normally, we start our presentations with disclosure on strategy, and then following governance, and performance comes last. But we thought that it is important to actually, you can do it the other way around as well, and starting with the end result of what you're striving to achieve and your disclosure to lead to. If you have questions, please put them in the chat box or unmute and ask them now, or after the other presentations as well. Jerome will stay with us to address them. Jerome, there was a question if there's any specific bonds for renewable energy projects, if you know now or if you need to think a bit.
I think, just to answer quickly, I think renewable energy projects are the easiest to finance among sustainable investors, because they fit in the green bond framework, they fit in the European Union taxonomy, which is becoming the industry reference. They can also be the subject of sustainability-linked bonds and loans, because with energy efficiency, you do achieve very measurable targets that are fairly easy to, I shouldn't say easy, but easy to measure, easy to project because of the technology. So both frameworks are relevant. And again, the way I look at it, looking at this quite a bit, the trend is towards companies issuing sustainable finance frameworks with these targets and this strategy, and then the second step is to decide, depending on the market and what your advisors, your banking advisor recommend, given the market conditions, whether it should be a green user proceed bond or a sustainability linked bond or loan. Sorry, Anne.
Thank you. Thank you very much, Jerome. And we will mention as well, I think at the end, about the key performance indicators and some types of these indicators and the work on convergence in this area, which is an important trend these days. So now we are moving to Anne Molineux, who will talk about the changes in reporting on corporate governance, control environment, and crisis response. And Anne is the vice chair of the International Corporate Governance Network, ICGN, the global investors network, with over 35 trillions under investment. She is also a business representative and contributor to the OECD Corporate Governance Steering Committee and an invited member of the OECD Asian Corporate Governance Roundtable. She represents ICGN on the International Auditing and Assurance Standards Board Consultative Advisory Group, the International Ethics Standards Board for Accountants Consultative Advisory Group, and the International Integrated Reporting Council, amongst many other things that she's doing. And many of you know her personally. So Anne, back to you.
Thank you, Riley. Can everyone hear me and see my slides? Is that a yes?
Yes.
Yes, great, thank you, excellent. Well, good afternoon, ladies and gentlemen, and good morning to those who are suffering the morning time. But it's afternoon here in Asia, and I'm down in Australia. And for those of you who know me, you know, in the course of this presentation, I'm likely to just ask you a question. So I intend to ask a couple of questions, so I'm hoping you'll be ready with some response, which would be helpful to our collective understanding of the issue. I'm here today to talk on changes in corporate reporting and corporate governance. Now, fundamentally, corporate reporting is on a very, very long journey which just continues. So if you're dealing with reporting from your company, you must be ready for permanent change. But recently we've had some very big changes, and particularly the greater emphasis on non-financial reporting or reporting on ESG activities. The fundamental issue is to attract capital, investors simply have to know about your company, all its strategies, its activities, and it has to also trust you. It has to trust that you're governing the company well and that the outcomes will be good, because any investor is usually not putting their own money in, but rather also putting in the money of other persons who might be beneficiaries from pension funds and so forth. So the changes in corporate reporting are large and will continue. And I'll just highlight one or two using, say, the corporate reporting we require on the board, but also I'll focus a little bit on the kind of corporate reporting we'll be looking for about your response to COVID and the crisis. So Nai, if you could just move to the next slide. Thank you. Our goals generally are to understand major components of reporting on corporate governance and focusing on the board, and also to consider reporting on COVID-19. And I'm going to be looking at a really practical level. I have several examples to show you about what companies are doing, and I've chosen good quality examples, but it will show you the depth and the quality of information that is required. Next slide. When we go to the next slide, you'll see a clear picture of what it is we, stakeholders and investors, want to know. It's in simple terms. We want to know that the company has a long-term future. And this is very difficult in these days because it's in the face of very uncertain, turbulent, unpredictable business environments. I mean, if you're in Australia, your business environment has changed massively because of COVID. We shut down the country for 4 months. So you had to adjust your business model for a 4 months gap in your activities, pretty much. We want to know that the company is well organized and run. In other words, that the company leaders can see the opportunities and manage the risks, some of which are in governance, some of which are in relation to the environment, some of which are in relation to change situations in the society in which we're operating. So I'll come back to the practical examples of all this a little bit later. We also want to know that the company's under control, that it is flexible, resilient, but also there are checks and balances in place, that you have an internal audit function, that you do have internal controls, that you have a very good external audit process and assurance on your other activities. I think we might move now to the next slide, which is about slide 4. Keep going, please, Nai. Next slide. Next slide. So going back one slide, Nai, thank you. So the starting point for reporting is to know your reporting requirements. This sounds small. It's actually not. Where do your reporting requirements come from? Well, some of them come from company law, some of them will come from tax law, some of them will come from labour law, some of them will come from environmental regulations, some of them will come from listing rules, some will come from your own articles or code of corporate governance. In order to understand the magnitude and breadth of your reporting requirements, you need to get across all of those. But fundamentally, we are looking for, an investor is looking for, continuous reporting of all material matters that may affect the investor decision or company operations. So you'll notice here the wording is quite specific. I'm talking about all material matters. So fundamentally, I'm not necessarily asking for you as a company reporting on your activities in, say, your annual report or on your website. We're not asking for a book. We are asking for selective but important material matters, that which affect either the investor decision, in other words, is it going to change my decision to invest, sell my shares, buy more, or just stay the same? Is it going to change, if the information is going to change the company operations or company risks or company financial performance or non-financial performance? We want to know. But I'd like you to address the first word on this slide, continuous. It's not a matter of doing quarterly reporting or annual reporting. It's about tell us when it happens, if it is a material matter. Don't delay. So communications with shareholders and stakeholders is going to increase, and it needs to be timely. And all shareholders and all stakeholders should have fair access to the information material to those investment decisions. But above all, those communications need to be balanced, consistently produced, in a comparable manner. In other words, we need useful information. I don't just need the good story. I don't want, it needs to be balanced. It needs to be honest. So not more reporting, but better reporting is what we're looking for. And we seem to have it pretty much under control in financial reporting after many, many, many years of practice. The information on financial performance and position of the company is vital. Information has to be objective, reliable, clear. Shareholders must be satisfied. They have sufficient information to make their investment decisions. And if they don't, they should ask the company, tell the company. But the latest move has been massively in the last area of non-financial reporting to shareholders, stakeholders, and markets. Relevant information on the environment and the way in which the company approaches the environment, its climate emissions reduction, its transition to carbon neutral products and services. We need to know all of that. And this is an area which is not really, it doesn't have a neat little set of standards, one set of standards. There are many set of standard setters and approaches to ESG reporting, which is why the IFC has been so clever to provide the Disclosure and Transparency Toolkit and shortly an e-learning platform, because it will show you what standards are out there and what companies are doing. So that's where I'm going to be focusing my attention for a little bit of this time. So going to the next slide, please, now. Now, here I'm focusing on reporting on corporate governance, but particularly reporting on the board and what we want to know. Now, remember that first colourful slide, which I said, we want to know that the company is well organised, is under control, has the right people in its leadership, and will be telling us about all of that. So here we are. We want to know that it has a good, strong corporate governance structure, a framework. In other words, we're ordered, we're organised, and we're ready. In other words, the right people are in the right place, doing the right thing, knowing their roles and responsibilities. So in a corporate governance structure, we'll be referring to knowing that we've got a board, and the board knows what they're doing and what their roles and responsibilities are. So I'll focus a little bit on the board because they are the leadership group of the company. So when we look at the roles of the board in governance, we want to look at that we're getting the right people as directors. So we want to know, if you're going to put in your annual report about the board, I want to know how you nominate a director to the board. So what is your board nomination process? And how, obviously, if I'm a shareholder, I'll also want to know how I vote for those directors. But we'll need to know about the board members, their names, their ages, their diversity, their experience, skills, knowledge. None of this is new, but it is a lot of information. So I'm going to try to show you how this information can be presented. We definitely want to know if a director is independent or not, or if he's an executive or a non-executive director. And we want to know in a way that they're not too busy, that they've got time to work on my board and not just work, on every other board and doesn't have time for my board. We want to know their capacity and their capacity to support the particular skills required on board committees. For example, if you're on a risk committee, do you have risk knowledge and experience? If you're on an audit committee, what's your financial literacy like, and what do you know about audit and audit rules and so forth? One thing we do want to know when we're talking about corporate governance, we want to know that the board and the governors, that is the chairman and the board, see themselves as distinct and having a very different role from management. On the board, we will want to see them overseeing, monitoring, managing, setting strategy, and I've lost my slides now. Setting time for strategy. But management needs to implement, to do the day-to-day activities, to manage, to implement, to ensure identification of risk and monitoring of risk and so forth. So now I'm going to get immediately into quite a few examples on what I mean about reporting all of this information, but reporting it in a succinct manner. Next slide, please, Nai. Okay, so now this is an example from an annual report of a fishing company in New Zealand. It's a very good example. Its annual report is a good quality annual report. But I want to know that the company is well structured and well governed. So here I can see in a summary version, and there's words that go with this, but that has a board of directors, that it has board committees for audit and finance and risk, safety, health and environment, people committee, which might be called an HR committee, sales and marketing board committee, and a board nomination committee. So I can see that this company that is into fishing and then exporting its fishing products around the world is well organised at the board level for those activities. And as I go down this summary diagram, you see the lighter blue in the middle, you'll see, okay, there's the chief executive officer, and he's leading the management team, the senior management team. And then underneath that again, I see all the business units. So if I'm reading this annual report, I will see they have identified in this diagram that they are well organised. They have boards and committees and senior management. They have business units. Down the bottom in the light green, they notice that they've got subsidiaries and joint venture businesses that they have to consider. And all of this is surrounded by their consideration for shareholders and stakeholders. Look at that line going around the diagram. It says shareholders on the top and stakeholders on the bottom. And underneath, the whole foundation of this is an ethical presentation, an ethical foundation. So you can see in that, we have conveyed masses of information in a simple diagram. So you have to find new and different ways to tell your story. If we go to the next slide, Nai, here we'll see a bank. And basically, to summarize this diagram, when we look at the company, we want to know that the board is really committed to continuous improvement of its own governance of the company, but also continuous improvement in company activities. And that's what this diagram summarizes. This is ABSA, the former Barclays Bank in South Africa. And they call their annual report their ESG annual report. And you will see what they want to achieve right in the center of this diagram. Governance outcomes of ethical leadership, good performance, effective control of the company, and trust and legitimacy of the company activities. So you see in those 4 squares around that central oval, they talk about their board governance activities, their risk governance activities, finance and treasury governance activities, and most importantly, social and environmental governance. It is becoming mainstream, and it will be on every annual report, I think, going forward. But if we move to the next slide, you'll see here how each area of governance is clearly delineated. In other words, the board and the chairman on the left, and the board is in the middle, and the chairman is on the left, and the group chief executive is on the right. This company is a bank in South Africa, and it shows there what the board does. And there is a clear distinction between what the board does versus what management does. And if you go down the central column, you'll see the board leads. The words repeat themselves: leads, approves, monitors, oversees, and overall leads the company. Whereas if you go down the right-hand column under the chief executive who leads the management, there you see the words manages, implements, executes. So this tells me this bank at least has a clear idea that the board has a leadership role and management has a do role. And those two should not overlap. Now, that's a good corporate governance outcome. So I'm happy to see that. But now it's over to you. So if we go to the next slide now, and I'm going to take the first 2 responses that come in, and I'm asking you this question. If you look at this picture, is this a good board? What's your answer, please? Is there anything coming up on the chat? Sandra, Krista, you've got no idea. Okay, so what do you think about this picture? Does it tell you that this is a good board? If I'm an investor, can I say, oh, great, I can invest in this company? So what does it say? Somebody says the gender is imbalanced. Yes, it is, because we can see 1, 2, 3, 4, 5 females. Yes, it is imbalanced because also the company secretary is not on the board, the chief operator, and so she's one off. So there's 4 women. It is a little bit. But what else? What other comment? Not clear of their roles. Thank you very much. Who else? Don't know their roles. Yes. So you are wonderful because, and Sandra, you are also very good. You said you can't see their skills. You can't see their roles. This is that same bank, KCB, in South Africa. And I'm showing it to you as a good example because this picture on its own is not enough, as you've all highlighted. So we can move to the next slide and I'll show you some more of the information that they give us that you're looking for, and you're right to be looking for it. Here we have their industry experience. With the photos, I could see, well, there were women on the board. It was reasonably diverse. There were diverse cultures and ethnic groups on that board. There were also relatively some age discrepancy, so you have a spread of ages. So you can see that from the picture. But this information here tells me, okay, here we've got good industry experience on the board and a spread of that. So I'm still happy. But is that enough? Let's go to the next slide now, and I'll show you what else they put on in their report. They then put much more information on each of the directors. They actually talk about their other experience, their other directorships, etc. So you can see I am now getting to be quite comfortable with this board. So you can see that information needs to be quite comprehensive. Moving to the next slide, I'm just watching the time now. Now, I'm going to give you some information. This is what I'm going to ask you to do. If you look at the bottom line of this slide, this is your question. If you're appointing the next director to this board, what skills might you look for? Now, to give you a bit of background, this board has a strategy to have a growth program into new investment products described as green, blue, and social bonds, ESG bonds, if you like. And this company is going to have, it has investments in real estate and is taking on new activities in insurance. So here we are. Go to the next slide. Now remember, next slide, please. Now, next slide. Now you'll see here, this is a board matrix. No, but go back one slide, please, now. Okay. You'll see down the left-hand side, this summarizes all the board directors, the names of the board directors across the top, and these are the qualifications and experience they collectively have. And you'll see we have lots of experience on business administration, business operations, corporate governance, finance, capital allocation, finance expertise, and so on. But we only have a little information. So what might we want? If we say we have this business is into insurance and real estate and wants to grow by issuing ESG bonds. If we're looking for our next director, what we'll be looking for? Risk expertise, thank you. What else are we looking for? What are we looking for? What more new experiences will we be looking for? Yes, environmental sustainability experience, good, excellent. Risk experience, someone with ESG experience. You put your finger on it. And if we go to the next slide, I'll show you. Go to the next slide, please, now. Here. So you see there's very little environmental sustainability experience. And if you're going to go into ESG products, you need that on the board. You're a bit weak in insurance industry experience and real estate industry experience. So this board matrix should tell you what information you need to get on your new director appointments. But this helps me as a voter as a voter on director experience.
Hello.
So I'm going to leave the board alone now. You can see
Hello.
you need a
I
lot
cannot
of
hear you.
detail.
Your voice is gone.
Could we mute, please? Thank you. So now if you could go to the next slide. Now thank you. I now want to turn to.
Yeah, I am not receiving any of your
Kind of could we please
funny.
mute?
You know, it's very unusual. You keep sending and like try to review
Excuse me?
like 3 days. There is no EFA. The one entering here is EFA.
I will continue.
The speaker is Rudy Balmater.
Rudy, can you please mute? Thank you.
You just send to my
Rudy,
Balmater@gmail.com.
Rudy,
So
could you please mute your phone? Rudy?
Even WhatsApp, you send me by WhatsApp, no problem. WhatsApp is very quick. I can convert.
I will continue.
Yes. You just send by WhatsApp.
My experience on corporate COVID-19 and reporting on corporate governance, I'll share with you a story.
Email is not functioning from your side. They have a
If I
problem.
might just say, if you're reporting on COVID, you need to report almost all of these informations here in this list that appears on this screen. But rather than talk to that list, I'm going to tell you a story about myself. And all this is public information because we've already reported to our shareholders. I am vice chairman of an organization which earns 70% of its income from conferences. And in January, February, and March and April this year, as a board member, it was quite worrying because we had to cancel all of our conferences and therefore 70% of our income. So what we had to do is we established very quickly a crisis committee of 4 individuals who would meet weekly because we needed to support our CEO in the business decisions she was having to make, the changes to strategy she was having to make, and certainly the changed working conditions when we had to send all our employees home. We had to report to our shareholders about how it is, what it is, and where and how we've taken steps, and what steps needed to be taken quickly and urgently. So I think it is a matter that we had to really move very, very fast. We needed to be, most companies need access to capital. We did not need that, but most companies have gone to access to capital. They have issued new shares. They have got very close to their bankers and issued new debt instruments. So financial reporting also becomes most important. But you can see when you're reporting on COVID, you need to tell it honestly and how it is. So I'm going to just move to the next slide and I'll show you, because I've only got 3 or 4 more slides. This is a survey undertaken in May 17, 2020. And this was an investigation of all investors to find out what information they want from companies around COVID-19. And it was done by PwC, the Boston Consulting Group. It's a case of they want companies to be transparent and honest, to tell us more about your company and the impact of COVID on your company. Tell us much more frequently. Give us more disclosure. Any changed metrics, change to strategies, change to data, change to remuneration, change to costs. Focus on liquidity and cash flow and profile, and focus on the long-term strategy. In other words, you have to take quick steps now, but what are you going to be doing to shore up your future? So if we move to the next slide, I'm going to give you an example of a company. This is Nedbank in South Africa. Now, you'll see on the left-hand column, their report. They closed their annual financial year closed in December 2019. In January 2020, they're developing their annual report. And in their original annual report, they said our top 5 business risks in January are business and country risk and so on, those 5 on the left. But when you get to February 2020, 1 month later, when they're finishing their financials and finishing their annual report, notice how their reporting and their risks on COVID-19 as a consequence of COVID-19 have changed. There are 3 new risks in there: people and operational risk, liquidity risk, and capital risk. So you need to report fully, honestly, but also in a very timely manner. And just to complete the discussion on COVID, I want to draw your attention to the next slide, please, Nai, to the annual report of Singapore Airlines. Now, they are one of the first airlines to come out with a full, complete annual report because their annual reporting period is to June 2020. And in their annual report, they have 4 complete pages on COVID reporting, and it is an excellent report. But I'm going to just read to you a few of the comments in that annual report to just stress the honesty that's required. Here are some of the excerpts. We have experienced an unprecedented impact on the aviation industry. We have had a sudden and precipitous fall in air travel. On the 26th of March, Singapore Airlines announced it would cut 96% of its scheduled passenger capacity. And it goes on, and right throughout the annual report, it comes back to us with strategy. It talks about the financial impact, the dividend impact, the company liquidity, where it's got its planes. They've got their planes back outside Alice Springs. So what I am saying to you, if you want to look at a quality report on COVID, look at theirs, but write it truthfully and honestly and give us all that information in your annual report. And going to the next to final slide, next slide, Nai, please. This is an investor survey. My perception of the quality of a company's reporting impacts my perception of the quality of the board and its management. 88% of investors agree with that comment. So if you are trying to attract capital from investors, you really do have to pay attention to your company reporting. Now, if we go to the next slide now, you will also see the IFC has COVID-19 support tools. This is a COVID-19 tip sheet, and the log on is down below, but there are many other tools you can go around and see on their site, helping you with both your corporate governance reporting and your COVID-19 reporting. So I think I'm going to leave it there for any further questions or discussions or comment, but I also thank you very much for your responses. So, James Semanchuk, I'm seeing here your comment. Are the common practices to postpone the announcement of audited financials and annual reviews? James, many countries have allowed some delay. You will be constrained in delaying those audited financials or issuance of your annual report by your regulations. So my answer to you is ask your regulator. In Australia, we did delay or gave flexibility for a delay to the audited financials and to the annual report. We also gave some considerable other flexibility in market regulation to help you access quickly cash to be able to shore up your liquidity. So to issue shares, you didn't have to issue a prospectus, so on and so forth. So a lot of the regulations were eased too. Nicholas, you're talking to me and to everyone, and you ask, how should we balance the need for honest, more frequent reporting? Sometimes you get pushback from legal departments. Yes, you do. And I have had that experience, not this year, but in many other years as CFO. And you do get pushback from legal departments. You have to tell as much as you possibly can, be truthful, but certainly if it leads you into defamatory areas, you have to also be careful. It is a very fine line, and it's a very difficult line. And in my experience with a CFO role on one particular disclosure we had to make, it took 1 week to agree 4 lines because we were going back and forth through the legal departments. So it's a very long and difficult process, corporate reporting. Tell it as it is. You must tell it as it is. And Raleigh has given you there to everyone more information on where you can find Sorry, my URL must be wrong, but Riley's given it to you all. Are there any other questions or comments that I can see? Riley, can you see any more I've missed?
No, thank you. Thank you very much. Very much, Han.
I'll leave it there. Thank you for your patience, everybody.
Yes, and we are available for questions as well after that, so we'll collect them.
Correct.
Well. So now we are moving to the value of reporting on strategy, on company strategy. And our next speaker is Susan Blessner. And for 20 years, Susan has worked with companies in Africa, Asia, Europe, and North and South America to develop their management and disclosure systems, building capacity and coaching companies on the path to integrated thinking and management. And prior to establishing the Art of Value, a global consultancy that helps companies define, manage, and disclose what matters most, she directed investor relations to several US companies and managed corporate and integrated reporting at IFC and Novo Nordisk. And some of her recent projects for investment advisory firms include development of new tools for water risk assessment. So now if you want to know how to not just sound good, but doing good, Susan is going to tell us how. Susan, back to you. Susan, we do not hear you. Susan?
Yes, okay. Can you unmute yourself, Susan? Yes, now we can hear you.
Can you hear me now? There's a few.
Yes, but we're hearing an echo. Are you on two devices?
I was. Hold on a second. Is this better?
Yes.
You can hear me now.
Yes.
Great.
Go ahead.
Okay, fantastic. All right. So can everyone also see me and see my slides?
Yes, indeed.
Super. Thank you so much. All right, we'll get started. If you could maybe continue on to the next slide. Super. Thank you so much. So as Riley explained, I'm a reporting practitioner. I'm not an academic. I do some work on standards, but my primary job is to work with reporters on how to actually produce reporting that works for them. So it's not just enough for companies to actually produce a report. For a report to actually be a good use of time and money and resources, it actually needs to be tailored to the company itself. And this is particularly true in the area of strategy, which is why I'm happy to talk about strategy. And I think that as a reporting practitioner, I think that IFC's tools for strategy reporting are incredibly helpful. So the one size, this, if we go back to that picture, thank you. The picture here, it doesn't really do you a lot of good to just have a pair of shoes. What you really need is a pair of shoes that fit. And the same thing is true with reporting. You don't want to just have a report. You want to have a report that's actually meaningful for your company, a report that actually showcases how the company is managed inside the business and why you have good management and why you're likely to succeed in the future and why you're a good investment. And this is particularly true in strategy because companies in different, even companies in the same industry may have very different strategies because they may be in different markets, they may have different regulatory frameworks, they may have different customers. So there can be huge differences in strategy, and it's really important to actually communicate it in a way that's very clear. This is also why strategy is something that's often not a part of reporting standards. It's not a part of all reporting frameworks. So that's why I'm actually really pleased that it's part of IFC's reporting tools. And what's helpful about IFC's reporting tools is it helps you get started with strategy reporting, and it also helps you get better and continue on your journey. So if you continue to the next slide, please. Super. So first of all, I have to apologize. There's a typo on this slide. The word not should not be there. So just to get us started in thinking about what is a strategy, because I find there's not always agreement on people's understanding of what a strategy is. So which of these is an example of a good strategy? So first of all, these are all types of targets and goals. So sales growth target, foreign exchange neutral sales growth target, or the objective to increase the number of women in management. So perhaps you could respond in the chat if anybody has any ideas. Are any of these good examples of a strategy? And if so, which ones? Any thoughts? Okay, so we've gone on and put up the answer. Someone said C. So the objective to increase the number of women in management. So to be clear, why the answer might be D. If we go on to the next slide. Can you forward? Thank you. So a lot of people, it's very common that people use objectives or targets as the strategy. But the objective of the target is actually, it's sort of the destination. And the real complete strategy includes the plan for how we get to the destination. So there's a lot of different elements to the strategy, and objectives can be part of it, but it's usually not the complete strategy itself. So once again, the strategy is a plan. It reflects specific choices that the company's making. And so the process of disclosing the strategy is also providing insight into the types of choices the company's making. And we want to see the plan, the path that the company plans to take to achieve its goals. Can you go to the next slide, please? Super. Okay, now the old way of reporting, most of a report would be historical information that happened in the past, and that's what most performance information is, right? It's the performance that has already happened. Now, if you think about this, when you're driving a car, there's a reason why the windscreen or the windshield is much bigger than your rearview mirror, because it's actually more important to see what's up ahead, what's coming forward. If you go to the next slide. Forward, thank you. So actually, there's something in human nature. We tend to believe that the future is going to be sort of a continuation of the past. That past performance, that historical information is going to give us a lot of insight into the future. And that's not necessarily true. That's almost sort of a flaw in human reasoning. And it's sort of a trap that investors often fall into, quite frankly. And it's also a trap that companies fall into in terms of disclosing what is critical to know about their company. Companies usually put too much emphasis on past performance. They put less emphasis on what's up ahead. But in fact, what really happens is investors are investing because they believe in the plan to deliver future results. If you make an investment in a company today, you're not buying past performance. You're buying the right to participate in future performance. So what you really want to base that decision on is a plan for that future performance. Now I have a little asterisk here. It's not just for investors. And that's because it's actually most stakeholders, many stakeholders actually really have a vested interest in understanding the company's plan to produce future performance. That includes employees. It includes potential employees that may need to understand where the business is going to make an informed decision about whether or not they want to join the company. It might also include customers, suppliers, and perhaps community. Okay, we go on to the next slide, please. Thank you. So IFC's e-learning tools So part of it is, of course, talking about strategy, and what I'm going to go through is sort of an overview of what's in the strategy overview content. So that includes two parts. So the first is explaining why a company would provide forward-looking strategy information. And we've just gone through the highlights of that. And then the second part is how. Once you know why you would provide forward-looking information, then how do you do it in a way that's really useful and provides maximum value? Because you want to provide information that's clear and really provides confidence that the company's making the right choices. What's really helpful about the way IFC has structured its tools is it gives companies a way to begin the process of reporting and then tips on how to get better and better. So I'm going to show you with a few examples sort of what that process can look like. If we go to the next slide. So in terms of how to actually present strategy in a way that's clear and understandable. So the actual strategy or the strategic plan is what's represented here in the red box. There's a lot of other information in addition to just the plan that provides helpful context that can help us really understand, first of all, whether the strategy is a good strategy, whether it's the right strategy for this business at this time. So the content in the gray circle and in the blue circles provides sort of the context to let us know, given the market this company operates in, given the types of customers they have, given the type of business this is, their assets, their capabilities, is this strategy a good fit for that business? Is this company making good decisions in terms of what kind of plan makes sense for them? And then the green circles on the bottom, you also want to disclose something about how the plan is going to be implemented. So along with strategy disclosure, companies want to provide information on how they're managing and measuring different aspects of performance and implementation to ensure that they'll actually be able to deliver on the strategy. So first, you want to report what the strategy is, which is our red circle, and then you want to report something about the context to make the case that the strategy is the right strategy. Then finally, you want to make the case that the company is capable of delivering on the strategy and that they have a good plan for doing so. If we go to the next slide, we'll get into some examples. And this example, of course, is from Malaysia. And this is an excellent way that a company can get started in providing forward-looking information and direction, sort of the direction in which the company is actually headed. So in this case, Simon Darby Plantation has 3 overarching strategic objectives, and these have to do with customer responsiveness, profitability, operational excellence. So these are areas that the company is focused on. They have linked these to their vision, where it is they want to go as a business, and then this is the easiest way to really get started in terms of providing some information about the path forward. They report on activities they've done in relation to the strategy in the current period and their plans for additional activities to implement the strategy in the coming period. So this is it's forward-looking information, but it's not a long-term strategy. It's not a 5-year strategy. But it gives you a sense of where the company is headed, and it gives you a little bit of detail to make an assessment about how well they're progressing and how firm or how good their plans and their choices might be. If we continue to the next slide, please. Thank you. Once again, another example from Malaysia, and that's just a coincidence. I'm not picking on Malaysia in any way or trying to highlight Malaysia. This specific example is, so in this case, once again, we have 3 strategy objectives. This is a pretty big business, and they're providing 3 strategic priorities for the overall business. Instead of a vision, what they've done here is linked these 3 priorities to the corporate purpose. And then they're not providing a lot of detail in this spread on how these strategies are implemented, but what they explain is the detailed implementation plans reside in business and functional strategies. So So this is very transparent in that this is actually what most companies actually do. In terms of how good those implementation plans are, you actually need to read more. We can't necessarily assess from this diagram here, but we know that they do have implementation plans, so that's helpful information. So once again, this is 3 high-level focus areas, strategy, priorities for the business, and then the rest of the report will provide more detail. So if we go on to the next slide. Thank you. So this is an example of a company that they're reporting a high-level corporate strategy. Once again, here they're linking to purpose. This purpose is probably not as clear and concise as our Malaysian example, but they do have a purpose, so that's helpful. But there's 2 things they're doing here that provides a little bit more accountability. And the important one is they have targets that are linked to the objectives. These targets are long-term and they have a time frame. So this also tells us what's the time frame for this plan. So the company has a vision and it has a plan, but that's also, it's time-bound. So that builds in accountability, and we have a sense of when can we expect this company to deliver on these results. So that helps us, it helps us better assess the quality of the plans, and also it's very important context for assessing performance and assessing reporting on an ongoing basis. So the other thing that this company is doing well is they have a growth strategy, which they state very clearly. And the growth strategy is really outlined in the 3 red bars at the top. And then under that, we see a yellow bar and a green bar. And that yellow bar and the green bar are really, they're really the sustainability strategies, or the management, the sustainability priorities that the company knows it needs to get right if the growth strategy is going to succeed. And that's the way this company explains it. So they've embedded sustainability, or they've connected the sustainability strategy with the core business strategy here. And if we look at their targets, this is obviously very small on your screen. They have financial targets, they have an employee engagement target, and then at the bottom where it says accomplished, there's actually a longer list of, they call them Mission 2025 sustainability commitments. And they actually have about 12 different environmental targets that are linked elsewhere, but they've created a link with the environmental targets in the corporate strategy. And this particular business is one of the Coca-Cola bottlers. It's part of the Coca-Cola system. And for them, what they know is that in order for them to be seen as a responsible business, in order for people to still keep buying their products, they need to be seen as a company that actually manages certain environmental issues well. And for them, that's particularly a focus around plastic, so plastic packaging, that they need to be seen as managing plastic waste responsibly, and also water. The primary ingredient in all Coca-Cola products would be water. So for them to continue to grow the business, they need to actually have a responsible strategy for managing water use and using water efficiently. And if they don't use water efficiently, particularly in certain areas of the world where there's significant water stress, it's going to impact their ability to grow the business. So that the growth strategy requires an environmental strategy. If we could go on to the next slide, please. Thank you. So the ideal strategy in terms of what we would want to see companies do eventually, which some companies are able to do now, looks a little bit more like this. So the ideal scenario for companies is that you start creating products and services, that you start offering and selling products and services where by selling your product or your service, you're also addressing some environmental problem or creating some social benefit. This is a company that's worked on changing their products so that they are achieving that. They are a forestry company and they produce paper packaging. And specifically, they're designing paper, fiber-based packaging, specifically to replace plastic packaging. So the goal here is that they claim to be a net contributor to preventing global warming as they're increasing sales, increasing revenue, increasing the value add of the products they sell. At the same time, they are claiming that they're reducing negative environmental impacts. So not all companies have these types of products and services. So if we look back at the Coca-Cola example, when you buy a bottle of Coca-Cola, you're not improving the environment. They know that, unfortunately. So in that situation, the embedding sustainability is really about offsetting environmental harm. But if it's possible, and more businesses than you would think actually are able to move in this direction, to actually sort of link the different types of performance together. So if we go on to the next slide, please. Thank you. So how to get even more transparent and more accountable. This is HSBC, a large global bank, and HSBC has a long-term strategy that has targets, and they report all that together. And then they go a step further and they report on that long-term strategy every year against those targets. And this is done in a very simple table. It doesn't have to be a huge amount of disclosure. It can be done very simply and very cleanly. In this particular example, what I'm showing you here is, this is I believe it's a 4-year strategy that ends in 2020. This was taken from the 2018 annual report. So they're reporting on the performance in 2018 and then also cumulative performance for the first 2 years of that strategy. And so you can compare how the progress they've made to date in a very detailed way against their longer term targets. And then what's in the highlight section is there's some discussion about what they've done and how things are going. If we continue on to the next slide, I've blown up a little detail from that slide. And actually, if we sort of zoom in on what's going on here, so if we look at strategies, their strategic priorities 1, 2, and 3 are actually part of growth strategies for growing the business. But part of that is actually by growing their business, they're also trying to have a positive impact on the environment by supporting through sustainable financing and supporting the transition to a low carbon economy. So in this way, they've actually fully embedded sustainability objectives into the core business, the growth strategy of their business. And also they're providing a lot of detail in terms of how the progress that they've made towards this strategy. So this is a 2020 target that they'd set of 100 billion in sustainable financing. What they're reporting is in the current year, they achieved 17.5 billion. The cumulative total would be 28.5 billion. So if we're halfway through the strategy, then what they're reporting very clearly is they're not halfway to the goal at the halfway point in the strategy. They may or may not see that as a problem. They actually discuss this in great detail. But I wanted to show this example because this is what companies are most afraid of when you ask them to report forward-looking information. Their greatest fear is that things will not go according to plan. And the honest truth is that things never go according to plan in life. That's just sort of how it is. And this is obviously particularly important in the current period. And this is also why many of the companies I work with, large companies all over the world, really see COVID as an opportunity to actually get better at reporting on changes in strategy. Because to be honest, while we think of this crisis as a really incredibly unusual event, for large global businesses, crisis is sort of what's normal. There's always some, political turmoil or some problem in some part of the world, some, economic disruption. So adapting to crisis is actually, a core business skill of many large companies. And being able to show how you adapt to crisis. Of course, COVID is unusual in that it's affecting all companies in all countries around the world at the same time. However, crisis is normal. It wasn't that long ago that we had the global financial crisis. It is entirely likely in the not too distant future there will be another sort of global crisis. So getting good at reporting on how you make adjustments in your strategy is really the best way to provide insight into your company, provide insight into your decision making, to actually increase the trust that investors and other stakeholders have in your management and your ability to deliver. And it's also just, this is really how reporting works at its best. It provides more understanding of actually what's going on inside. So if we could continue on to the next slide. So just to recap, why do we want to report on strategy? We want to report on strategy and we want to provide forward-looking information because investors are buying the right to participate in our future performance. And this, of course, is not just important to investors. We go on to the next slide, how we do that. You want to disclose the strategic plan, what's in that red circle in the diagram I displayed earlier. Then you want to describe the context for that strategy and also how that strategy is being implemented. If possible, the ideal is to embed sustainability into that strategy as much as possible. It may be that the best a company is able to do based on their industry, based on their sector, based on where they are, is to link the sustainability and the core business strategy. They might not be fully embedded. And then, of course, also reporting against progress against targets provides a real additional level of insight and accountability. So, are there any questions for me on strategy disclosure or how to get started? I'll open it up to questions if you go on to the next slide. Thank you. So there's a question from James about sustainability reports from Indonesia. They lack measurable KPIs of stakeholders' performance. Stakeholders' performance, and I'm not sure exactly what you mean there, but how important are these to attract investors? So I think what's actually really important in terms of what you disclose in terms of KPIs, obviously, I think one of the things that's really important is while we're encouraging disclosure, we're encouraging accountability. We're not encouraging a 500-page report, or in Indonesia, I know there are reports that are almost 1,000 pages. So there's some very big, very detailed reports. More is not always better. I think the most important thing is that you have KPIs, that you report performance that directly links to the strategy, to what the business is doing. So in terms of KPIs around stakeholders, it depends how much insight that would provide into the business. And obviously, so for the purposes of this conversation, we're primarily focusing on how you disclose strategy in the context of an annual report. So, and it is true, of course, a lot of companies disclose some pieces of strategy in a sustainability report and some pieces of strategy in a financial report. And it's helpful to sort of bring those together. That's actually obviously the benefit of integrating ESG into the financial report, is not to have different pieces in different places, because that can be very confusing to investors. I hope that answered your question. Are there any other questions? I don't know, Rally, if anyone sees any other questions that perhaps I've missed. And if not, I believe at this point there's a video clip we're going to show, if that's ready. And this is actually, so what I'll say is this is a video clip of, it's an interview of one of IFC's client companies, the Indonesian Infrastructure Bank. So IFC is a investor in this bank, and they have helped them some with reporting. And the company's talking a little bit about Well, they have a number of very large institutional investors, IFC being one, the Asian Development Bank being another, that actually the disclosure still has tremendous benefits, including helping them attract additional capital.
We do not hear it. We're still not hearing anything. Nia, I'm sorry, we're not hearing.
I suggest we move on and keep that video to the end.
Let me quickly try to share from my screen, and if it's not working.
Do you find that your employees do they find useful information from the disclosure, or do you think the information and the lessons plan in other ways?
Unfortunately, we cannot hear. Yeah, let's keep this video to the end.
Okay. Okay, Leo, thank you. I understand. So we'll keep it to the end and try to fix the problem. So now we are moving to our next speaker and a very exciting topic on the leadership and communication in crisis. And we're going to hear from Eric Vermeulen. So Eric is first a professor of business and financial law and the director of the International Business Law Program in Tilburg University and the Netherlands. And he teaches business organizations and governance, law and technology, and business innovation and finance. Secondly, Eric is a senior legal counsel at Signify, formerly known as Philips Lighting, and he works on corporate matters, mergers and acquisitions, and reorganizations. Third, Eric can be described as a content creator, sharing insights in his blog in Medium, how emerging technologies are creating new opportunities across all areas of the economy and society. And finally, he's a co-owner of a Michelin star restaurant in the Netherlands. So, Eric, back to you.
Okay, thank you so much. And good afternoon, everybody. We have to ask this question. Can you see my slide?
Yes, we can.
Oh, that's very good. Now we're in good shape. Okay, yes. So we hear a lot about disclosure and transparency and reporting, and how important it is. But I can tell you it's even more important than we realize, particularly in times of crisis. I think it was mentioned several times, but right now, when we talk about disclosure, transparency, and reporting, I think you should realize it's not about just reporting anymore. It's actually about starting a dialogue, having a dialogue with your stakeholders. And your stakeholders could be investors, could be anybody else, could be your employees, could be your consumers. And this is a kind of trainer session. So we start with the context. And as was mentioned, I work at a company called Signify, which was formerly known as Philips Lighting. And you see the two light bulbs here on the screen. And that's the starting point of this presentation to show you how important reporting, disclosure, transparency, and actually having a dialogue and a communication strategy is in these days. So here we have the two light bulbs, and I like starting with these new light bulbs, and I ask them what's the difference between them. Well, I will give you the answer. On the left-hand side is just a traditional conventional light bulb that we have. We started the company in 1891. And the light bulb, well, it got better and the light got better, more energy efficient. But now we are at the time that we have the light bulb at the right-hand side, and that is not a light bulb anymore. This is a connected device, a data device, and even an artificial intelligence. And that provide the context for this presentation, because these two light bulbs, they need completely different leadership style and a completely different way of communicating as well, particularly in times of crisis, particularly in the time that we have right now, the COVID-19 and the post-COVID-19 context. So when we look at the light bulb on the left-hand side, well, that's a very simple leadership structure, actually, that many companies still have. So we founded the company in 1891, but here you see from 1945 to 1975, what a leadership structure was about. We had a very paternalistic leadership. And that time, I think, well, there was not so much disclosure and transparency. We just believed the family. But things changed rapidly when we continue from the 70s to, let's say, the early 2000s. More and more, we realized that the company had to move their leadership from a paternalistic leadership to a more professional leadership. And we see more and more rules and regulations emerging, and they required more and more reporting and a better governance structure. What's very actually interesting to see, if you look at this slide, you see these pictures in the middle. These are like the CEOs of the company. And at the top, you see the chairman of the board, and they call them the presidents. What was kind of interesting is that when a CEO left, he became the chairman of the board. That cannot be done anymore. But that was good in the 80s in order to provide continuity in the company. But here you see that corporate governance became more important, and we wanted to have independent chairman, independent from the CEO and the company, and that's what you see here happening in the 90s. And back then, I think it was all about reporting. I actually have all the annual reports of Philips here. I collect them. And what you see is that the number of pages that we provided to the market was increasing rapidly because we had more and more regulations to comply with. And that's extremely interesting, because then the question is, how should we report and what should we report? And I think back then in the 90s, 2005s, it was about reporting almost everything that we have. And it was very difficult to find the information. But we complied with the rules and regulations. But now we live in a completely different time. As I mentioned, the light bulb is not a conventional light bulb anymore. It's a connected device. Another thing is that the light bulb that you could see on the right-hand side will last so much longer. A normal light bulb will last for 2 to 3 years. The new one, 10 to 15 years. So business models had to change, management structures had to change, but also reporting had to change significantly. Because here's what happened with the company from the, let's say, late 70s to now. And I joined Philips at like 98, almost 22 years ago. No, exactly 22 years ago. And you see that the number of employees is going down. The company was restructuring continuously, getting leaner. You hear that all the time, leaner and smarter. And in 2015, Signify emerged as a spin-off of Philips, and that was mainly a lighting company. But the most significant change in leadership was the openness. From a closed, let's say, corporation that was reporting to the market, we became more like an open organization that having a dialogue with the market. And I think that's very important to realize these days. So we went from a paternalistic leadership to a professional leadership, a corporate leadership, to what we see right now in this time and age, a digital leadership. And there's no company in the world that can ignore this. Whether you are in mining, whether you are a bank, whether you are a lighting company, whether you are an electronics company, a gaming company, you have to open up and you have to embrace a digital and more open leadership structure, because this is where we are right now. And I think this is one of the most important things to realize these days. And it doesn't matter whether you are in a growing economy, an emerging economy, it's everywhere the same. So in the 90s, we saw long product life cycles, steady industry environments, and there was a need for innovation, but it was not that important. That changed in the 2000s, where we see, oh God, yes, we need to innovate. But it was what we call evolutionary, not revolutionary. You didn't see a lot of disruption. That really changed in the 2010s when we had like the digital transformation. All products had to be smart. We went from products to services. We see platforms emerging. For instance, take Indonesia, where we see Gojek becoming extremely big, and not a ride-sharing company anymore. It's a fintech company. It's in health tech. It's almost everywhere. And that's what we also see in this world, that industry boundaries are disappearing. We see shorter life cycles of companies, but also shorter life cycles of products. Completely new markets and new competitors. To give the example of Signify, we had like 3 competitors for years, and now we have 500 in just a couple of years. And then that was all fantastic. And yes, we saw this exponential growth of technology, but then 2020 happened. And nobody could have predicted COVID-19, but that changed everything completely. When I have meetings now, it's not about knowing where we go anymore. It's about how to deal with a new economic reality, how to deal with a new normal. And the new normal is everywhere. The way we work, working from home, how consumers behave, how competitors behave. We just don't know what will happen tomorrow. And in that world where we see the new normal emerging, and we see that the environment and climate change is becoming more important. We see that we focus more on health. Think COVID-19. As was mentioned by Anne, diversity and inclusion becoming very important. As I mentioned, changing industries and boundaries, and a changing world and consumer behavior. That's where we are right now. And that's where you as a business, and again, it doesn't matter what kind of business you are in, you have to deal with. And we simply know, and that's what the question mark tells you, we don't know where we are going. And that means in that world, where things change so rapidly, and where we went from, if I take the lighting example again, from a light product to more like light as a service, now to light as an experience. That's all fantastic. But in order to make that move and in order to deal with the new economic reality, well, you cannot be structured as a hierarchical corporation anymore. You have to become more open. And what you see at the bottom of the slide is actually from a Chinese company called Haier. They do washing machines, dryers, fridges, and they made a huge transformation from this hierarchical company to more like a flat organization. And in that world, when you are a leader, a manager, or you work there, basically 3 pillars are extremely important. Pillar number 1 is the technology. Every company has become a tech company, period. Number 2, organization. You cannot be organized anymore as a hierarchical structure. That old corporate thinking is kind of disappearing. People don't want to work there. People are more attracted by open organizations, platforms, and you see how disruptive they can be, particularly in Asia. But we are not focusing in this presentation on the technology and the organization. We are focusing on the communication and how reporting is becoming much more than reporting. And that's why we have this subtitle of the presentation in the agenda. It's called The Quiet Transformation of Disclosure and Transparency. And I think this transformation is extremely important to understand, and we need much more training about it. And that's why I'm so happy to participate in this meeting, in this event, because this is where we are. And now we're going to focus on the reporting. On the left-hand side, you see how companies were organized. You had investors, you had the CEO, top management, mid-level management, even lower management, non-management, lowest non-management, lots of levels, lots of layers, lots of divisions, lots of departments. One of the questions referred to the legal department of a company. And I can tell you, I work at a legal department of a company, but we are not viewed as a legal department anymore. That we are becoming part of product development, as I will explain in a second. So the company where we have all these processes and procedures, all the seniority and all the compliance, that's fantastic, but it doesn't work anymore. We have to become flatter. We have to co-create with all our stakeholders. So we have to involve investors. And as Anne was mentioning, it's so important to report to them, but also to involve them in the dialogue, to engage with them. You have to engage with your consumers. You have to engage with other companies, and these other companies can be competitors. They can be companies that you couldn't even think about in the past. You need them as partners. Yesterday I was talking with a manager that works at the Dutch telephone company, and he said, well, we are moving into fintech rapidly, so all of a sudden he had to work together with banks. He never did that before. And in that world where we talk to other companies, startups, research institutions, governments, employees, third-party developers, in that world where we have to figure out what the new economic reality is, reporting, but even more importantly, communication and having an open dialogue is extremely important. And that's not new. I think the companies that performed best over the years are the companies that are pretty open and are very honest, because they realize that if you try to hide things, it's impossible in this world. You cannot hide anything anymore. So then the question is, do you want to bring the bad news yourself, or you want others to bring the bad news about you, and then you lose control over almost everything? And I think that's something that is very important to realize, that when you are open, you have to be honest. Of course, you have to be smart, but you should realize that you cannot hide things anymore, not for long. And when it comes out and you're out of control, it's extremely difficult to fix the reputation, the reputational hit that you just suffered. So to give you an example of a company that became very open, and to show you that the dialogue was so important, I'm going to give you the example of the company that you could invest into let's say, one of the best companies to invest in over the last decade. So from 2010 to 2020. And I could ask you the question, what company do you think was the best investment over the last decade? Many people would answer with, these are probably the big tech companies like Google or Facebook or Apple or Amazon. But that's not true. Domino's Pizza was a much, much better investment over the last decade. And why? Yes, we probably love eating pizzas, but the thing is that Domino realized in 2009 the company didn't do well. Stock price really didn't do well. And they said, okay, what should we do? We need to change our strategy. We need to come up with something different. And what they actually did is they opened up. They asked the stakeholders, the consumers, what do you think of our pizza? And they were very clear. The pizza was like cardboard. Didn't taste that good. It wasn't nice at all. Service was bad. And they opened up and said, well, this is what you think of us. And we want to change that with you. And by having this dialogue, by reporting, they actually show that they cared. And I think that's what you should realize when you write or draft reports, when you want to have a corporate communication strategy, show that you care. Just putting a lot of things on paper as boilerplate or copy pasting from other companies, not the right thing to do. You actually have to think about your strategy, what fits you, and how can you show the market that you care and that you want to have an open communication, an open dialogue. When Domino's did it, and I encourage you to look at this and look at how they report on ESG these days, it's fascinating. But that's showing that you care about the community, that you care about the environment, and that your company is much more than just a pizza company. And at the bottom of this slide, you see that the company itself now, they consider them as a tech company, and they have digital futurists on board, opening this dialogue with the stakeholders to figure out what the next economic reality is. So that's just a fantastic example that people will not realize because people are thinking of other companies when you are talking about the best investments. So I give you another case study just to show you how you can report and how continuous reporting, it was mentioned, how important continuous reporting is. This is not just about the annual report anymore. It's about continuously updating the stakeholders, continuously updating the market. And we did this within Signify as well. And I give you this example to show you how quote unquote simple it can be. So in September of this year, so let's say 2 months ago, we became carbon neutral. And you can just report on that, but you can also communicate it in a much fancier way, in a way that really resonates with stakeholders and with investors, and it did. So the starting point was the Sustainable Development Goals. And I think we discuss them all the time. You find them everywhere. And they could be a fantastic starting point for your reporting, for your communication strategy. So the 17 that you see here, within our company, we focused on 6 of them. And they became what they call the strategic compass. And it's not only the strategic compass for your strategy, but it's also the compass for your reporting strategy, for your communication strategy. So good wealth and well-being, affordable and clean energy, decent work and economic growth, sustainable cities and communities, responsible consumption and production, and climate action. They focus on this when we come up with a strategy, but also when we report. Now, when you go on the website, and I encourage you to do that as well, and I just give you some examples, what you see is in a very clear this is just the website, the company's website. You see carbon neutral. You see all kind of things here about vision and progress, sustainable lighting, sustainable operations, product compliance, to show you that this sustainability has become part of the product, has become part of the service that we sell. It's the strategy in itself. So you cannot just say, well, oh yeah, we have to think about ESG. No, ESG becomes part of your strategy. That's what your consumers, your investors, your other stakeholders expect you to do wherever you are. You can just not ignore it. Now here we see the head of sustainability coming up with something. But what really resonated is not only that we put a lot of text there, and I'm not going to show you the video because we see that that could be difficult, but there's this video online which just explains in like 7 minutes, signifies carbon neutral, and it explains the why, how, and what. And using video, I think, is one thing that we should not ignore when we talk about reporting these days. Also, investors love to watch videos. It's so much easier to watch something to show instead of just telling and writing. So that's one thing that you see on this corporate website is a very clear video of the why, what, and how. Then we go beyond it. In the reporting, in the communication strategy, we just do not only focus on our product and what it brought us, but we also show what it can bring you. So what the benefits are of a carbon neutral company and buying its products and services, what it can do to you and your community. I think that's extremely important when you do reporting, when you do communication, that you also put yourself in the shoes of the receiver. And I think that was mentioned several times already, because you have to realize that when you report, when you write something, when you disclose something, it's not just to comply with a rule, it's actually to open that dialogue, to resonate, and to have impact with your stakeholders. So that's one thing that you can find on the website as well. Then on the website, you find some data. Yes, data on what we achieved and how we achieved it. Very simple, very clear, as was mentioned by Susan, and Anne, in very clear, simple diagrams. That's what people like, because we don't want to read a lot anymore. We also want to get it in visuals. Then I think what is extremely important when you report and when you have a communication strategy is that you give case studies. So we said, okay, let's focus on some case studies in India and some case studies in Africa. What did it do, and how did it help our company grow? And I think that's extremely important, and also something that people do not really expect. But here you see how ESG has become part of the strategy of a company and how we can actually use it, communicating it to you as a stakeholder by just giving examples and case studies. But what resonated most when we were disclosing the carbon neutrality and when we are disclosing ESG is not just the disclosure of somebody who is in sustainability. It's not just showing some case studies. What resonated most was the CEO announcing it. And this is also a video that you can watch online. But here you can see again the journey on the left-hand side. And this is on the website. On the right-hand side, you see the CEO's announcement. Now, I encourage you to go online after this meeting and watch both of them. And then think to yourself, which one resonates most? The one on the left-hand side is a beautiful video that explains the journey. And I like that video. But what resonates much more is when the CEO is explaining in a very authentic way what he did, why the company did it, and what the impact was. So much better. So when you report, don't make it too corporate. Try to make it also authentic and use CEOs or other top managers to explain to the world the why, what, and how of ESG. It will resonate much better, and you will get a much better dialogue with the market. So focusing on that, I think there's one brilliant example that we can all learn from that shows that when a CEO starts writing something in a very authentic way, making it sometimes even personal, will resonate a lot. And I think the best example in the world today is Amazon. So Jeff Bezos, the CEO of Amazon, he writes a letter to the shareholders every year. They started in '97 when they listed, and they do it now for 23 years. And every year they have a new letter, and the 97 letter attached to it. And you learn not only about the company, but also why the company made several changes, of how they think business should be run. There are business and management lessons in these letters. And these letters become a culture in itself. You see what happens. People start writing books about the letters. You see people start coming up with infographics about the letters. You see people on YouTube start analyzing the letters. And I think that's what you want when you start reporting. It's not that you just put something in a booklet and put it to the market and don't look at it anymore. You want people to pick it up. You want people to think about it. You want people to respond. You want to have that dialogue, because having that dialogue is an extremely important business tool these days. And I think that's what you should realize. And Amazon is just one example. Another example that I give you that is doing it very well is a company called Gymshark. This is the fastest growing company in the United Kingdom. And it's a sports brand. It's a sports apparel. And the reason why they are so big and the reason why they were able to attract investors was their openness and their communication strategy. I think the communication strategy for them is even more important than the product itself. Better, their communication strategy is part of that product, is an extremely important part of the product. So as Susan was mentioning, you have like the purpose and the mission and the vision, which is here. It's very clear why they exist. But around that purpose, they create a culture, an openness, a reporting and communication culture that really, really resonates with many, many people. And that's why they grow so fast. So they use reporting, not just to report, not as a marketing tool, but as a communication tool to their audience. And their audience are the younger generation, Gen Z and millennials. But it works really well. So when you talk about reporting and disclosure and transparency, you think about it, there are more ways to disclose. It's not only the annual report. There are so many other things you have to do. Your website, maybe your social media, all kind of things that you have to think about and that you have to align in order to get a good communication strategy. And that brings me to the one more thing, the last thing that you have to do. These days, when you are in crisis, and you have to deal with a new economic reality, you don't really know where things are going, your communication strategy becomes probably your most important business tool. One other thing that you have to realize is when you communicate, do it in a clear, accessible language. It's using visuals, it's using, as I mentioned, videos, it's using almost everything. And a company in the Netherlands that's doing it pretty well is Tony Chocolonely. This is a chocolate company. Go to their website. It's all about ESG. I think ESG is part of the reason why they are now one of the biggest chocolate companies here in the Netherlands. But the way they communicate is also very interesting. What you see on the right-hand side, just as an example, is their employment contract. And we were talking about legal departments. You should show this to a legal department and tell them, well, here you see an employment contract of a company in the Netherlands. I think it will scare the hell out of them. But more importantly, it will make them think of how to report and to use simple and accessible, plain language. And to show you that the show don't tell, to show you that this is so important, give you another example of the company I work for. This is one of their products, Connected Lamp. It was reviewed by a tech reviewer. And normally these tech reviews, they focus on the hardware and the software. But here all of a sudden, you see that they also discuss the privacy policy, part of your disclosure as well, your policies. And they liked it so much because, as it's written here, which does a better job than most of explaining the company's data practices in plain English. And I think when you do reporting on whatever, on ESG, on your privacy, on your governance, on your social, do it in plain English. Don't use the corporate language anymore. It will not resonate. Or to put it differently, if you want to have more impact and you want to have a better dialogue with the market, and you want to make reporting and disclosure and transparency a part of your strategy, do it in a plain, accessible language. I think that's extremely important, because we have to realize that these days, when we talk about corporate governance, it's not just about having a system of checks and balances. In times of crisis, particularly now, management doesn't know what is right. They don't know where things are going. So your system, your corporate governance, but particularly your communication strategy, should help you find what's right. And that brings me to what I think is one of the best definitions of corporate governance these days. And I just found it online when a serial entrepreneur in the United States, Gary Vaynerchuk, you see him on the left-hand side, was answering a question from the girl on the right-hand side. And her question was, so here we are in a time of crisis, and I don't know what to do. What kind of choices should I make? So we all have to make new choices. And he said, well, we don't know. It's not about being right up front. It's about creating a system that helps you find right. And I think we should realize that corporate governance is that system that helps you find right. And your corporate communication strategy, your reporting, is a crucial component of that system that can help you find what's right. Thank you so much, and I open the floor for questions.
Thank you, Eric, for always an exciting and inspiring presentation. There was a question to you: if you use CBTI to ensure that your strategy were aligned with the 1.2 future, and when you say Signify is carbon neutral, does it cover your scope 3?
Yeah, when we say Signify is carbon, does it cover your scope 3? Don't really understand what a scope 3 is. So if that person
It was. Nicholas, are you online?
But I think it's just a general answer, and then we can take this offline with a person if you want.
So sorry, scope 3. Yeah. Scope 3 is just for basically reporting the emission induced by your products and services.
Okay.
And usually companies will just commit to be carbon neutral for their scope 1. But if I am a huge oil producer, and if I commit to be carbon neutral on my scope 1, it is quite easy. If I want to commit on the scope 3, which is basically what we need if we want to have an economy which will be aligned with climate change challenges, it is a different story. And this is precisely, I think, what investor can be interested in.
Exactly. No, you're absolutely right. But this then was a scope 3. Yeah, you can read it on the website, and it was very well received by the investors, which made me happy as well. Stock price went up, but it was not only the investors, it was also very well received by consumers who are becoming more environmentally conscious. And that's why this was that's why the company was so proud, and that's why it was announced. This was not a simple achievement. So yeah, thank you for your question, but it was definitely more than a simple thing. This is what we want. This is what we want to achieve, and that's why it was covered almost at all media, like CNBC. They all covered it because it was quite an achievement, particularly in this industry.
And Eric, maybe I can do a follow-up question in terms of like assurance and verification of the data for your report. That's also an important topic that Anna raised. So maybe you can share your experience. That would be interesting, I think, for participants.
Yeah, can you repeat, because I could not hear your first part? The data?
The verification and assurance of the sustainability and ESG data of your report. I think it will be important for participants to hear your experience.
the experience of the reporting, of ESG reporting.
Verification and assurance of the sustainability.
Okay, yeah. No, I think, but that is extremely important, and that's where I bring in the show don't tell, and that's where you have the dialogue. This is more than just a report. This is something that people can check, and that also brings me to I think to Nicholas' question. The way it was reported, it's something that people can. It's like an academic, like a research report. It's something that can be verified. It's something that can be checked by people. It's something that can be copied by others, and that's why I think reporting becomes so much more than reporting. I think that's what we should realize, particularly these days. And I'm serious. Whenever I'm in a management meeting, whenever I'm in a leadership meeting, it's all now about the new economic reality that we have to figure out. And I think whatever we can do, whatever we so I was in another discussion about corporate governance, and we talked about ESG, and I think ESG is just more than governance. It's a strategy these days, and I think other participants like Anne can hopefully support this view that when you are an investor and you just look at ESG, it's not just the report that you did. It's not what Nicholas first said. Okay, this is how we do it in ESG. It's how you make ESG part of your strategy when you enter the market, when you want to develop your company, when you want to do corporate growth. Without ESG as a significant pillar, you are not going anywhere. And in order to make sense of that ESG, you have to report on it, but also have a dialogue, report in a way that people can actually react and respond. It's extremely important these days. That's my my experience. And so somebody else asked a question about soft copy reporting. Interesting. Yeah, I think we see more and more soft copy reporting in the sense that your internet and downloadable videos become more important than just having hard copies. Let us be honest. Most people have an iPad or read on phones these days. So yeah, whether that's, by the way, more energy efficient, I don't know. I'm not going into that because I read somewhere that whenever you open or do something online, it has an impact as well. But I'm not an ESG specialist in that regard. But yeah, I think when you report, you have to use all means possible these days. Again, reporting is becoming more than reporting. It's becoming more than marketing. And somebody told me once, every company is a tech company these days. Every company is a media company these days. And I think that's right. But you have to be careful there. It's what Anne said. It's not just about telling a nice story. It's about being honest and telling what a company is about. And when you realize that when you are honest and you explain to the market what your company is about and what they want to do, that's becoming a business tool for you to figure out what you have to do yourself in the future. So use it as a strategy tool, make ESG part of your strategy, but use reporting as a business tool to get feedback as well, to help you figure out where your company should go. I think it's extremely important. Capital markets days are not just showcasing, it's having a dialogue with the investors. You have companies that invite consumers in hackathons to their campuses in order to have a dialogue with the consumer, to figure out together, to co-create together what you want. And you see this in tech companies, but you see it in more traditional industries like oil and gas and finance. You see it everywhere. You see it in China, you see it in the US, you see it in South America. So it doesn't matter where you are or what you do.
Anne, you have a comment.
Yes, I do. I'd just like to go back to Eric and his question or comment on assurance. Your question, Riley, Eric's comment on assurance. We are noticing at the IAASB, who also produce assurance standards for the accounting profession. Now, that does not incorporate all ESG activities, but we are experiencing a considerable demand for assurance on ESG information and are reviewing the standards so that it can allow not just the accounting perspective, but also the other engineering and social assessments as part of the assurance. Those who are investing are very keen to see this assurance because it gives them some comfort, if you like, on the words that are presented on the page.
Yeah, that was exactly, this better put than but it's very early here, and so, but this is exactly what I meant. Is this the check that you have, like with not only the so-called experts, but also the industry and the engineers and the technologists, and that everybody can actually understand what it is. That gives it more credibility, and that's what we need these days.
Thank you very much. So in the beginning of the session, we promised to present what and how to disclose material ESG issues about company strategy, governance, and performance, and tips for communications and crisis response. So we covered quite a few of those, covered these topics. And if you remember Jerome's circle in the beginning, on the strategy, governance, and performance as well. We looked into the 3 different areas and the disclosures there. And now we will hear from our co-host today, from the UN Sustainable Stock Exchanges Initiative, Anthony Miller, on the regulatory and stock exchanges perspective, and some of the UNSSC model tools on ESG disclosure. And Anthony is the coordinator of the United Nations Sustainable Stock Exchanges Initiative, which is an initiative of 104 stock exchanges around the world, and the focal point for corporate social responsibility within the investment and enterprise division of UNCTAD, the United Nations Conference on Trade and Development. He has managed the Sustainable Stock Exchanges Initiative since its launch by the UN Secretary General Ban Ki-moon in 2009. And in 2011, the initiative was named by Forbes magazine as one of the world's best sustainable ideas. So Anthony, back to you.
Thank you very much, Relitza. And good morning, good afternoon to everybody on the call. I have to say, I've really appreciated the presentations in this workshop. I think there's some excellent points being made, not only about examples of good disclosure practices, but some of the fundamental points that disclosure is about communication, and that disclosure and ESG are really about the strategy of the company. Really fascinating conversation. And appreciate it, and you know, just would be happy to dive more into those topics. But I realize that we're a bit pressed for time, so in a spirit of trying to get us a little bit back on the agenda, I'll try to be brief with my comments. I was asked to speak a bit about practical resources on disclosure and transparency. We've learned a lot today about this IFC tool, and of course other tools out there. I just wanted to run through just again the global context, which we heard just in the previous speaker's presentation about how they use the Sustainable Development Goals as a starting point to help them to identify key aspects for their company. I think that's an incredibly important point, and the UN Sustainable Development Goals are a very useful tool to help focus the company, to ask the company what exactly is your purpose in society, what global challenges, what local challenges are you trying to solve? And I think this is what the world is looking for in companies these days, are companies that are solving problems for consumers in terms of their individual daily lives, but also solving problems for societies, whether that's at the local city level or at the country level or the global level. And I think companies that solve problems are companies that are valued by both investors and consumers. So this is a critical global context. I'm glad to see it emphasized so much by some of the other speakers on this call. And we do have the next decade. It's the decade of delivery on these goals. And a decade is a long time. I always like to remind people become discouraged, particularly in the context of the events of the past year, about our chances of achieving many of these goals. And I would just like to remind people again of the space race of the 1960s, that when people set out on that space race, they had none of the technology required to get to the moon, and yet they still tried to do it. And they succeeded on doing that in a decade. A decade is a long time. If you think about your own country, wherever you are in the world, I guarantee you, if you think about your own country and just think over the last 100 years of your country, there's going to be a 10-year period where you saw a really dramatic change. And this is what we're looking at over the next decade, a dramatic change in achieving some of the world's most pressing sustainability challenges. So with that, let's get back to sustainability reporting and the kind of practical resources that issuers, companies can expect from organizations. Of course, the United Nations Sustainable Stock Exchange Initiative were focused on the efforts of stock exchanges and security market regulators. In this context, what we've been hearing from the previous speakers about growing focus on sustainability activities, on ESG activities, what have stock exchanges been doing? Here you see a trend line over the last 20 years where there's been an enormous ramp up of activities among stock exchanges, as exchanges themselves recognize the centrality of sustainability to business in the 21st century. So we've seen this huge ramp up of activities, and many of these activities are focused on assisting issuers in their own efforts to produce more sustainability reporting, but also transparency around sustainability products such as green bonds, social bonds, ESG equity indexes, and the like. So in the context of today's discussion on sustainability reporting, I'm just going to zero in on the work that exchanges have been doing around disclosure guidance. In most countries in the world today, the stock exchanges are offering guidance directly to issuers. And I think this should be one of the starting points of any company in their reporting journey, is to look at what the stock exchange advises in terms of the local expectations in your marketplace. You can find on the SSE website a comprehensive list of every stock exchange guidance document in the world, or you can, of course, reach out directly to your own exchange in your own country. If you're a dual listed company, you may want to look at the other exchanges you're listed on, at their guidance documents to see how they might differ. Most of these guidance documents have a lot in common. I'll circle back to that in a second. The other thing I wanted to point out here is the tremendous surge in ESG reporting as a mandatory listing requirement in markets. And that's this lower dark line. There's about 24 markets in the world now that have ESG reporting as a mandatory requirement. And really just in the last 5 years alone, we've seen a huge surge in that, really a doubling of that. And we fully expect that in the next 10 years, this decade of delivery for the Sustainable Development Goals, this line will continue to go up, following the pattern of what exchanges have done with their voluntary guidance programs. And by 2030, ESG reporting will likely be mandatory in most of the major markets in the world. So it is, of course, good to get ahead of the curve on that and the learning curve, and to be ready for the future markets as soon as possible. On these guidance documents coming from exchanges, you can see that the guidance documents, they're building off of major sustainability standards and frameworks in the world. This is what these guidance documents refer to. 95% of them are referring to GRI, 75% referring to SASB, and so on. That you get a sense that these guidance documents, that they are convening, centering around a few key global standards. And we are seeing more and more of these standards converge. Just in the last week, it was announced that SASB and IIRC are now merging. And we are having our SSE Q4 webinar coming up next week. where we're inviting all of these standard setters to talk about their convergence coordination, because we know this has been a source of confusion for some issuers and report preparers when preparing the reports about which standards they should use or how these different standards and frameworks relate to each other. So that it's an ongoing topic, and in many of these guidance documents coming out of exchanges, in our own work and the IFC's work, there's a lot of explanation about the interrelationship between these products. But there's also a lot of activity going on in the space about the potential merger and increased alignment between these products going forward. So this is good news. The other key area that our stock exchanges have been extremely active is in training activities. And training activities where they're developing these themselves, they're partnering with international sustainability standards organizations, they're partnering with organizations like the SSE, the IFC. Of course, we've done a lot of these types of workshops with exchanges, and the IFC is partnered with exchanges all around the world. It's one of the reasons why we have this collaborative relationship with the IFC. And there is support from your exchange in your own local market. And this is useful to engage with your exchange on these types of training activities, to learn from your peers in the marketplace about what they're doing and how you can match local best practices, but also to engage in dialogue with investors. I think the point just made earlier that reporting is really about creating a dialogue. I think that's crucial. And a lot of these training activities are multi-stakeholder in the sense that they include issuers and investors. And that is a really useful approach to bringing people together. So I encourage all of the issuers on this call to take advantage of these type of training activities, to reach out to your stock exchange and get involved in this ongoing dialogue in your own market. I just wanted to end by talking a little bit about the support we provide to exchanges and regulators. So any of the exchanges and regulators on this call, that there is support in this capacity of training trainers. We, of course, also have our strategic partnership with the IFC to assist in capacity building at the exchange level. But as so many issuers look to their exchanges for guidance on these topics, it's critically important that exchanges themselves increase their knowledge and capacity to deliver information to their marketplace. So with that, Relisa, just a few takeaway messages that we are operating in a new policy environment now, defined by the UN's Sustainable Development Goals. And these are not only shaping public policy, but as we've just seen in the previous speaker, they're helping private companies to shape their private policies, to shape their key priorities and targets on how they're going to make a difference in society going forward. And in that sense, creating value for the company, value for shareholders, for consumers, and their broader stakeholder community. The other key takeaway is that ESG disclosure is a general mainstream market expectation around the world. We've seen this in the guidance documents of stock exchanges. More than half of the exchanges in the world now have guidance on ESG disclosure, and that was not the case just 5 years ago. So it's a tremendous new mainstream expectation of the marketplace, and it's increasingly becoming a mandatory requirement in many markets around the world. And within the next 10 years, we expect it to be mandatory in most markets. And the last thing is just to say that there are a lot of training available. I just talked about this, and it's available from a number of different sources, of course, from us and from our partners at the IFC, but also some of the main standard setting bodies, GRI, SASB, et cetera, that are providing training directly to the market. So there's a lot of resources available. So anybody who struggles with this topic, they should not feel like they should struggle alone. They should take advantage of these resources, often free training programs that you can avail yourselves of. And with that, I'd just like to conclude and again, thank the organizers of this webinar for such an excellent discussion and the speakers that came earlier. I really appreciated the conversation, the dialogue, the key points made. Relita?
Anthony, thank you very much, and thank you for very successful collaboration with you, USC and USSC. We worked with 8 countries and like 5 more now. We are working with the regulators and stock exchanges on updates of their corporate governance codes, integration of ENS issues there, scorecards on ESG and ESG disclosure guidelines in the regions. We worked in the Philippines, but as well Kazakhstan, Kenya, Rwanda, Iraq, Georgia, and we're doing work with Ukraine, Morocco, amongst others. There is a question about the ASEAN corporate governance scorecard, and that it's currently very weak on environmental and social issues, and where does it fit into that? And maybe you want to take that question because you worked quite significantly on that.
Yes, I'm very happy to. Look, the ASEAN scorecard is always in development. It doesn't get developed, it gets developed almost in groups, if you like. It went through 5 years and then it had a couple of years off, and they came forward with a whole new focus, meaning the focus that is relevant at the time. I would suggest it would be coming up for review again quite soon. Those markets are very aware of the need for ESG reporting, because the ASEAN scorecard is working very much to move the whole of ASEAN together so it can offer such things as ETFs and cross-market indices and so on. So it will be coming forward. I have to double check with them, but it's certainly on the agenda.
Thank you. Thank you very much. Any more questions? What you can also do is we can collect the questions and pose them and prepare answers after the training as well. So if there's any particular questions or issues that you want more information, please feel free to send it to Leal and Anar, and we can prepare answers. I'm mindful of time, so I will take a few minutes just to share the IFC approach to disclosure and transparency and some of our initiatives and programs in this area and in the region. You can contact Anar and Leal for further information on that. So as you heard throughout all the presentations, it takes a coordinated actions from state actors and non-state actors in order to improve the ESG disclosure and to improve investors' confidence and to mobilize the 2.5 trillion in funds per year to reach the Sustainable Development Goals. We need deep, efficient, and transparent global capital markets with offerings that speaks to investors in sustainable products. And this involves multitude of players. Global market regulators need to take steps to encourage sustainable finance and strengthen ESG practices, disclosure, and transparency. As Anthony just said, this is an evolving area, and the regulation has picked up in the last years. Stock exchanges and regulators must produce ESG disclosure rules and guidelines that meet local and international best practices, and companies that have better practices will gain better access to debt and equity finance. which can ultimately contribute to meeting the SDGs. So we saw the gap between investors and companies on ESG practices and created a tool and currently an online platform that demystifies and streamlines all current reporting standards. And there is an ongoing work, as Anthony just mentioned, on convergence in these areas. The tool provides practical step-by-step guidance how to prepare annual reports, integrating material ESG and financial information into company strategy, governance, and performance. And as I mentioned in the beginning here, we're not talking about philanthropy or corporate social responsibility activities. We are talking about the environmental, social, and governance factors and their impact on the strategy and performance of the companies. This helps track the SDG target 12.6.1, which is about number of published sustainability reports in a country. So we started small with the intent to help our own clients progress on their reporting journey, how to move from basic and intermediate to good and leadership practices. And what we created is not in an ivory tower in DC or Vienna. It was created and tested on the ground with companies, stock exchanges, regulators, investors, association of different size and complexity in Timor-Leste, Kenya, Rwanda, the Philippines, Kazakhstan, China, Georgia, Iraq, Ukraine, and Morocco. And we introduced a supporting disclosure and transparency program for emerging economies, where we work with investors, regulators, companies, and in some cases, market intermediaries to provide more comparable and consistent ESG disclosure. With these tools and resources, our goal is to help encourage adoption of strong industry practices related to ESG disclosure. And our latest guidance is on disclosure and transparency and COVID. And this program, as you see, includes the policy support to stock exchanges and regulation, technical support on developing guidance, frameworks, codes, listing requirements, and other mechanisms. And Leo said that in the region, we have helped development of 30 such codes and regulation, capacity building, assisting companies, and strengthening their environmental, social, and governance practices, and preparing integrated and best-in-class annual reports, investment solutions and recommendations for such types of product, and an online platform offering flexible learning opportunities, reporting tools, and community for emerging market companies, stock exchanges, and regulators to integrate ESG and corporate reporting and disclosure practices. And if you need any particular tools or have recommendations what to include, we are happy to take your feedback. Quickly, here are 3 global trends and our response to it. As you heard today, companies can no longer afford to ignore ESG issues. Just as we individuals have each faced uncertain territories in our daily lives due to the pandemic, the same is true for the business, and that companies have needed to look beyond shareholders and consider their stakeholders. You heard a lot about that from Eric and Susan as well, how companies need to look into their consumers, the communities they're working with, and research has shown even pre-COVID that companies that adopt stakeholder-oriented approaches deliver stronger financial performance, especially during times of crisis. And the cost of inaction can be up to $1 million a day for companies in infrastructure sector for non-operation due to issues with affected communities. There are over 2,000 studies on the relation between ESG and financial performance. What is interesting these days is that sustainability has an impact on the resilience of companies in times of crisis. The data provider Refinitiv looked at the losses during COVID-19 pandemic of firms that are in the top and bottom 10% of ESG scores. And they find quite a remarkable correlation that companies with more sustainable practices have 50% less losses than the companies which are at the bottom of the ESG scores. And this effect is particularly pronounced for sectors such as utilities, materials, and healthcare. Institutional investors are ramping up their efforts when it comes to assessing performance of companies using environmental, social, and governance factors. This is a recent survey of Ernst & Young of over 300 institutional investors, seeing that they do look at and based their evaluations on corporate disclosures, but also showing that they're dissatisfied with the quality of disclosure and the provision of real-time information of what Eric also mentioned, that the annual report is the main source, but ongoing communication and disclosure is really important. The SDGs, the importance here is that they can be used in two ways. Firstly, companies can measure and report their impact in relation to SDGs and implement new ideas. And you see this link in a lot of reports in the region and all over the world. Secondly, organizations and regulators can use the SDGs as inspiration and design criteria for new product development and business process innovation, such as the SDG bonds that Jerome talked about. There was the question about the scorecard. So here you see the holistic approach of different regulatory tools which help build sound, sustainable, and green capital market and how they're connected. Starting with legislation that defines and sets rules for all company forms, to codes of corporate governance, which inspire and ensure quality corporate governance. And the last 3-4 years include governance of environmental and social issues. And 80% of all codes in the world have stakeholder engagement section. Scorecard is an instrument to assist in a survey and assessment of ESG practices in a country and builds on the introduction of the corporate governance code. As Anne said, it's a dynamic and evolving tool, which is very useful to provide baseline and gap analysis of the practices that are missing. The ESG reporting guidelines are providing practical guidance on disclosure and transparency of ESG and financial information that is decision useful for investors and feeds into tools for investors and an analyst for evaluation of ESG and sustainable finance product, not just the green bonds, but beyond what Jerome talked, general purpose bonds for SDGs. We have a set of tools that are freely available that we develop based on our regional experience around the world and global best practices, such as the one for codes for best practices that we use for the development of 145 codes around the world, a scorecards toolkit, which provides guidelines of the different assessment models used in more than development of 25 ESG scorecards that are constantly evolving the Disclosure and Transparency Toolkit that you hear today about on the disclosures as a disclosure guide, and the online platform that will help you understand what to do to improve disclosure and transparency, and how to do it. All these tools are based on best practice experience, all the current reporting framework that Anthony just mentioned. This is a very fast evolving field, but also on our own methodologies, our own performance standards of environmental and social sustainability, and corporate governance methodology for assessing our own investment. And one of the parameters is on disclosure and transparency. This is the excerpt of this methodology, which is freely available on our website, and the progressive levels there. We provide advisory services to companies around the world on ESG practices and disclosure, and consistently in all regions, the first issue companies raise about disclosure is its cost, and that it's only for big companies, that it is too expensive, then followed by issues related to confidentiality of information and how much of the strategy can be disclosed. But at the same time, what investors seek, and you heard from Anne and others, is information on the business risk, environmental and social information, and not just historic but forward-looking information, something that investors can base their decisions. In a lot of regions, annual reports look more like a marketing brochure with boilerplate language, with very few information on risk, governance of environmental and social issues. For that, based on these reasons, we developed the toolkit, and now working on the platform to streamline all the reporting frameworks and provide you a guide of how to develop such report. It provides a flexible approach based on the 3 pillars on the strategy, governance, and performance, aiming to create a dialogue inside and outside of the company. It has a lot of examples of how to disclose from different regions, and the platform will create community as well, where more companies can share this. And it also looks to do it to provide guidance how companies can do it in a more progressive way, not just from 100 to there. One of the most sought section of the toolkit that now we are developing as an online tool is a mapping tool between the different reporting frameworks. What is their audience, what they're designed to do, what are their definitions of materiality, and particularly what's their audience and what they're aiming to achieve, which has an impact of which one or combination of which ones do you use as well. The toolkit has a model structure of annual report, which can, with guidance under each section, which can help you look into more tips and guidance how to do it, but also how to improve the underlying practices. We have the COVID guidance for during and post the COVID crisis, but generally disclosure in crisis, because there is always some crisis in the world that are affecting the companies. An important section that Jerome mentioned as well is the factors, metrics on environmental, social, and governance factors, some of the most commonly reported ones around the world, and some examples of KPIs for during the COVID time. It's all available online, and as I said, we are currently putting it into an online format where we are going to have a section with resources, e-learning available for everybody with different modules, tools for creating an outline of an annual report, and a tool for gap analysis and annual report self-assessment as well. And here is the tool for the COVID-19. So thank you very much. Leal, back to you.
Thank you very much, Ralitza. I would like to thank all of our eminent speakers for sharing their insights on various pertinent topics regarding disclosure, transparency, and governance. I'm sure all of us have learned a great deal from their enlightening discussions. We don't have much time left, but we would still like to hear from the participants about their plans in terms of improving D&T practices in your organizations, or if you're a regulator in your respective country, and of course any kind of support that you may need from IFC in the future. Although we will reach out to you separately after this TOT, but maybe we can spend a few minutes hearing from you. Is there any participant who would like to share his or her thoughts, reflections, next steps?
Can you hear me, Leo?
Hi, Kim. Yes, we can hear you loud and clear.
I think, from Myanmar perspective, being an emerging market, probably in terms of making this more holistic, and including in our reporting. There's a lot of things that we don't disclose in your reports, which I think is the first place to start. And this is really a good time because in 2022, Myanmar is actually going to be fully compliant with international financial reporting standards. So if we can pick up some of the ESG elements, together, around the time that we are fixing the way that we do our reporting, it will really be good. In terms of, having policies on related party transactions, contingent liabilities, that is also, a good place to start. And we don't really say a lot in terms of our board compositions, in terms of who are our directors, how long they've been, sitting on the board, and the responsibilities that they hold, as well as whether they have other board positions on top of the current, company that they're sitting on. So if we can also have, a little bit more on the board reporting side to give, shareholders and the readers of the financial statements more comfort in terms of, what is, board role in terms of corporate governance, not just, solely focusing on the management doing that job. So that's my wish list. Thank you.
Thank you. Thank you very much, Kim. Any other participants?
Another comment from Myanmar from me, Vicky. Yeah, this is Vicky here again from Myanmar. I know Nikolai is on the line as well, and we're both hard at work trying to finish our 2020 Puntissa report. So just to say, as you know, I think we've been using the ASEAN Corporate Governance Scorecard as a starting point on that, but we do find it very weak on E&S. But what is at least positive is that we're seeing companies looking for frameworks. So between last year's report, Puntissa report, and this year's report, We've now got a further 5 companies to go on Myanmar agricultural, the sort of Covent Garden vegetable market, Mayex, Max Myanmar, TMH, and UAB, who've joined Sitimar, FMI, Shui Down in using that scorecard. So I think there is an appetite amongst Myanmar companies for having this framework, and we're seeing them gradually adopt frameworks.
Thank you very much, Vicky. Any other participants? Okay, I believe there are no other participants who would like to share their feedback. Maybe we can close our session here. So thank you again for all speakers as well as participants for taking the time and attending this event. Directly after this session, we will be sharing with you an evaluation form. Please feel free to provide your feedback through those forms. Also, I believe you all receive the material which we use during this TOT. If you haven't received them, please reach out to IFC. So thanks again. Take care. Bye.
Thank you.